All right, so we've got this stack of investing stuff you gave us, huh? We're going to deep dive into Benjamin Graham, A&D, dollar cost averaging.
Okay.
Two pretty different approaches, right? Like Graham's all about those undervalued companies, right? The margin of safety stuff. But then DCA, that's like consistent investing no matter what the market's doing.
Yeah, you got it. At first glance, they might seem totally separate, but the interesting thing is how they can actually work together,
Yeah.
to build a really solid long-term plan.
Okay, so before we get all into that synergy stuff, let's make sure we're all on the same page. Remind me again, what's that whole margin of safety thing that Graham's all about?
It boils down to buying assets for less than their real value. Think of it this way. You wouldn't buy like a damaged car for full price, right? You'd want a discount to make up for the repairs. Well, Graham's margin of safety is kind of like that discount, but for stocks. Protection from downside risk, even if your valuation's a bit off.
So it's like a buffer, just in case things go south. But how do you even figure out a company's real value? That sounds like really complex.
It does take some work, that's for sure.
Yeah.
Graham, he was big on fundamental analysis, meaning you got to like really dig into those financials, earnings per share, book value, all those financial ratios, PE ratio and all that.
Ah, the PE ratio. It's like comparing a company's stock price to how much it earns, right?
Yeah, exactly.
But with all that number crunching, isn't there still like some guesswork? How do you know you're not just swayed by like all the market hype or even the pessimism?
Well, that's where Graham's Mr. Market analogy comes in. He saw the market as this emotional guy, constantly offering you prices based on his mood. Some days euphoric, others totally down. You, the investor, you got to be the rational one, ignore the noise, stick to your own research.
Okay, that makes sense. Don't be swayed by the emotional roller coaster. You got to make your own judgment calls.
Right. And, looking back at some of Graham's criteria for those defensive stocks, it's crazy how even those old school concepts can still apply. Like his rule about annual sales, he said companies should have at least $100 million in sales to be considered like defensive.
Wait, but wasn't that like way back when? $100 million then is probably what, half a billion today?
Yeah, exactly. It shows how much things have changed, but some core principles still work. Just got to adapt them to today's world.
Right, so it's be selective, find those bargains with Graham, but then you've got DCA, which is like more of a slow and steady kind of thing.
Exactly. Dollar cost averaging takes out all the emotion. You're not timing the market, just investing a fixed amount regularly, like building a brick wall, one brick at a time, no matter what the weather's doing.
Okay, so if the market dips, you're getting more shares at a lower price, and when it's up, fewer shares at a higher price.
Right.
It's kind of like automatic buy low, sell high without even trying.
Exactly. And the psychological benefit there is huge. It keeps you disciplined, especially when everyone else is freaking out.
But hold on, wouldn't a lump sum be better if the market just keeps going up? Like if you have the cash and you just put it all in at once and ride that wave?
That's true. In a constantly rising market, a lump sum might be better.
Okay.
But let's be real. Most people don't have a ton of cash just sitting around. DCA makes investing doable. You build wealth gradually, even with smaller amounts.
Okay, that makes sense. So DCA is good if you're not sitting on a pile of cash but want to invest regularly.
Right.
But I gotta ask, isn't there a chance DCA underperforms? What if you miss out on those big gains because you're not all in at the very bottom?
It's a valid point, and DCA is not some magic formula to get rich. But the data actually shows most people who do lump sums don't outperform those who do DCA. They get scared by the market's ups and downs, end up selling at the wrong time, lose their gains.
So DCA helps you avoid those emotional pitfalls.
Exactly.
I can see the appeal there. It's like having a little investing coach whispering, don't panic, stick to the plan.
Right. And what's really cool is you can combine the best of both worlds. The discipline of DCA with the selectivity of Graham's value investing.
Whoa, okay, now I'm really interested. Tell me more about this hybrid thing.
Imagine this. You've done your research, found a company that fits Graham's criteria, got that nice margin of safety. But instead of going all in, you use DCA to build your position over time.
So you're saying you're kind of double dipping on potential gains, buying an undervalued stock and smoothing out your entry point with DCA, maybe even lowering your average cost?
That's the idea. It's like buying that damaged car, but negotiating a payment plan, maybe getting an even better deal in the long run.
Okay, I'm starting to see the power of this combo, but we got to remember this isn't just set it and forget it, right? We still need to do our homework, look at the financials, really understand the companies.
Absolutely. Thorough research is crucial no matter what. No blindly following formulas. You got to understand the business, its industry, its potential.
Right, it's blending the numbers with the story behind the company. I'm feeling like a financial detective here. But before we get carried away, there's something we haven't even touched on.
Oh, you're right.
What is it?
Before any strategy, you got to understand yourself as an investor. What's your investment personality?
Ooh, deep question. Are we thrill-seeking active investors or laid-back passive
And
ones?
it's more than that. Are you an investor focused on long-term value or a speculator looking for quick wins? Knowing your risk tolerance, your goals, your time commitment, it's essential.
So before even thinking about DCA or Graham, we got to look in the mirror and figure out what kind of investor we are.
Exactly. Once you know that, then you can find the strategies that fit you, your goals, and your comfort with risk. That's when the real magic happens.
This is already making me rethink my whole approach, but I feel like we're just scratching the surface here.
We've laid the groundwork, but the real journey begins when you apply these concepts to your own situation. There's a lot more to unpack, so much to learn.
Okay, you've definitely got my curiosity piqued. Let's give our listener a moment to digest all this amazing info. But don't go anywhere, we're just getting started. We'll be back in a flash to delve even deeper into these fascinating investing strategies. Okay, so before we took a pause there, we were talking about blending DCA with Graham's value investing, and you mentioned something about applying this whole hybrid approach to ETFs, which is kind of new to me. That's not something I've heard before.
Yeah, it's an interesting idea, right? Most people think of ETFs as like those passive investments, but what if we could actually use Graham's principles to like actively choose ETFs that might be undervalued?
Hold on. So we're talking about finding ETFs that are trading for less than they're really worth, just like we would with stocks. But how do you figure out what a whole basket of stocks is actually worth?
That's where it gets a little tricky, but exciting too. You got to look at what the ETF holds, analyze the actual companies in there. Like, how are they doing financially? Are they making consistent earnings? Are they undervalued based on Graham's ideas?
So it's like doing mini value investing on each stock inside the ETF. That sounds like a lot of work.
It does take effort, for sure.
Mm.
But remember, we're hunting for those hidden gems, the ETFs that the market might be missing, and the payoff could be big.
Okay, so you get the diversification of an ETF, but maybe you're buying it at a discount too, like a two-for-one deal.
Exactly. But even with ETFs, we can't just look at the numbers, right? You got to consider those other factors too.
Right, like how's the management? What about fees?
Yeah,
And the risk of all those assets inside the ETF.
you got it. Got to
Okay.
look deeper, really understand what you're getting into. And that brings us back to knowing yourself as an investor.
True. Not everyone's got the time or the knowledge to do this deep dive on every ETF, right?
Right. Some people might prefer a simpler way, sticking to like those broad market ETFs or ones for specific sectors. And that's totally fine. The key is finding what fits your personality, your goals as an investor.
I think that's a really important point. There's no one right way to invest. It's all about finding what works for you, your situation, your risk tolerance, and your overall vision for the future.
Couldn't agree more. And, even if this specific hybrid thing isn't for you, it shows how important it is to think outside the box.
Yeah, we've been talking about Graham and DCA, but there are tons of other ways to invest out there. The point is to be open to new ideas, challenge the conventional wisdom, and to always keep learning and adapting.
Absolutely. Investing is always changing.
Yeah.
What worked in the past might not work tomorrow. So, got to be flexible, stay informed, and be willing to adjust your strategies as needed.
So we've got combining different approaches, thinking outside the box, adapting to the market. But what about those like timeless investing principles, the things every investor should keep in mind no matter what their strategy is?
Well, one that immediately jumps out is diversification. Don't put all your eggs in one basket, right?
Mm.
Spread your investments around different asset classes, different industries, even different parts of the world.
Yeah, diversification. It's like don't bet on just one horse, right? Helps to lower your risk and smooth out those ups and downs that always happen in the market.
Exactly. And speaking of risk, another big one is risk management. Know how much risk you're comfortable with and make sure your investments match that.
Right. It's about finding that sweet spot between potential reward and the risk you're willing to take. And that sweet spot's going to be different for everyone.
Exactly. And, another principle that people often forget is patience.
Ah, patience, that virtue that's so hard to actually practice these days.
But in investing, patience is key. Don't expect to get rich quick. Building wealth, it takes time, discipline, a long-term perspective.
So it's like ride out those market storms. Don't freak out when things get bumpy. Keep your eyes on the long game.
You got it. And speaking of those short-term ups and downs, there's another side to investing that we should talk about.
I'm listening. What else should we unpack here?
It's the mental game of investing. Those emotions that can mess with our judgment, make us do irrational things.
Oh, yeah, we've all been there. FOMO, greed, fear. They can really wreck your portfolio if you're not careful.
For sure. It's easy to get caught up in the hype or the panic and make decisions based on feelings instead of logic.
So how do we avoid those emotional traps? How do we stay cool when the market's going crazy?
One thing that helps is to have a written plan for your investments. It lays out your goals, your risk tolerance, your strategy, even your exit plan, if things go wrong.
So instead of reacting to every little thing the market does, we can check our plan, make sure our actions still make sense for our long-term goals.
Exactly. It's like a roadmap, guiding you through those market storms, keeping you on the right path.
Okay, I like that. It's like having rules to follow, even when your gut's telling you to do something else.
Right. It takes discipline, but having a plan can really help you make those rational decisions, even when the market's making you nervous.
One thing that stuck with me from these sources was the idea that investing isn't just about making the most money. It's also about, like, aligning your investments with your values, right?
Yeah, that's what they call sustainable investing or ESG investing.
Right. It's about putting your money into companies and causes you believe in, things that are doing good in the world, like environmental stuff, social responsibility, good corporate governance.
It's a way to support things that matter to you, maybe even make a difference with your investments.
So it's not just profits. We're thinking about the impact, the footprint our investments are leaving on the world.
Yeah, and it speaks to a bigger trend. People are realizing that their investments have power, that they can use them to push for positive change.
So we're not just investors, we're citizens too. And we can use our investments to reflect our values, our hopes for a better future.
I love that. And speaking of a changing world, there's another piece of the puzzle we can't ignore in this digital age.
Okay, I feel like you're about to drop another one of those timeless principles on me.
Not a principle exactly, but an essential element. Technology. It's changing how we invest.
True. Tech is changing everything, right? And investing's no different.
Yeah, online platforms, robo-advisors, algorithms, AI research tools. Tech is making investing easier to access, more efficient, and potentially more profitable.
It's like having a team of financial experts in your pocket.
Exactly. But like any powerful tool, tech should be used carefully. We can't just blindly trust these algorithms or let robots make all our decisions.
Right, we got to be in control, understand how the tech works, what it can and can't do, and what the risks are.
Right. It's a balance. Using the power of tech, but still making our own choices. Staying in charge of our money and our future.
So we're using tech to make better decisions, not letting it make decisions for us.
You got it. And, one thing that really impressed me from all this research was the focus on giving individuals more power.
Oh, interesting. What do you mean by that individual empowerment in investing?
Well, before, investing was like this exclusive club, just for the rich or those with special knowledge. But today, because of technology, because information is more available, because people are learning more about finance, investing is becoming more democratic.
So it's not just for the elite anymore. Anyone can learn, get into the market, start building their own financial future.
Exactly. And that's incredibly empowering. We don't have to rely on big institutions or so-called experts to handle our money. We can take control ourselves, make our own choices, shape our own futures.
Wow, that's really inspiring. We've gone from the nuts and bolts of DCA and Graham to this whole new world of possibilities. I'm feeling pretty fired up right now.
Me too. It's an amazing time to be an investor. With the right knowledge, the right tools, and the right mindset, anyone can reach their goals, create the life they want.
But before we get too carried away, let's give our listener a moment to take all this in. We've covered a ton of ground, from the basics of value investing and DCA to diversification, risk, patience, the psychology of it all, and even the role of technology. It's a lot.
Yeah, it is.
Hang in there, everyone. We'll be back in a sec to wrap up this awesome deep dive into investing. And we've got one final question, something to think about that'll hopefully keep you going on your investing journey long after this is over. Okay, we're back for the final part of our deep dive into all things investing. I feel like we've really gone through a lot, from Graham's bargain hunting to the whole DCA discipline thing, even how those ideas could apply to ETFs, which is pretty wild.
Yeah, we've definitely covered some ground. But there's always more to learn, and as we wrap up, I think it's good to leave our listener with something to chew on, a question to ponder as they keep going on their their own investing journey.
Ooh, I like a good thought-provoking question. What do you have for us?
So think about this. How can you take everything we've talked about today, the principles, the strategies, those insights, and use them to build your own unique approach to investing? One that fits your goals, your values, your vision for the future.
That's a great question. It's not about copying someone else's playbook or chasing like the hot stock tip of the day. It's about using this knowledge to build a strategy that really reflects you, who you are as an investor, what you want to achieve.
Exactly. And that strategy, it'll probably change over time as you learn more, as your life changes, as the market throws you curveballs.
So it's a process, right?
Yeah.
Always learning, adapting, refining your approach. It's not about finding the perfect strategy, but the one that works for you and that you can stick with long term.
For sure. And remember, investing isn't just about, making the biggest pile of money. It's about financial security, peace of mind, and ultimately having the freedom to do the things that matter most to you.
That's a really good point. It's about using investing to build a life you want, not just for wealth's sake.
Exactly. Sometimes the best returns aren't measured in dollars. It's the experiences you can have, the relationships you build, the good you can do in the world.
Well said. I think we've covered a ton in this deep dive. We explored Graham's wisdom, the power of dollar cost averaging, and even how to maybe combine those with ETFs, which is still kind of blowing my mind.
We also talked about knowing yourself as an investor, managing risk, staying informed, and using technology the right way while still remembering those basic principles that have always worked.
And most importantly, I think we encouraged our listener to really take control of their financial journey, build a strategy that reflects them, and see investing not just as a way to make money, but as a path to a richer, more fulfilling life.
And it's been awesome sharing this journey of knowledge and discovery with you and with our listener.
Uh,
Hopefully this deep dive got them thinking, helped them understand things better, and gave them the confidence to take that next step in their own investing adventure.
Thanks for joining us on the deep dive. We'll be back soon with another fascinating exploration of ideas and insights. Until then, keep learning, and as always, happy investing.
All right, so today we're diving into the world where Benjamin Graham's value investing principles meet dollar cost averaging.
Okay.
I love it.
Sounds good.
We've got your notes and articles ready, so let's see what we can uncover together.
Yeah.
It seems like you're the kind of person who wants to know not just the what, but the why behind successful investing, right?
Absolutely. Understanding the why is what separates a good investor from a great one.
I completely agree. So before we get ahead of ourselves, let's break down these two concepts, dollar cost averaging and value investing, just to make sure we're all on the same page.
Of course.
Okay.
Dollar cost averaging, or DCA, is essentially investing a fixed amount of money in a specific investment at regular intervals, regardless of the price at that moment.
Got it.
It's a bit like setting your investments on autopilot.
Okay, so it's about consistency and discipline, not trying to time the market perfectly.
Precisely.
Okay.
Now, value investing, as championed by Benjamin Graham, focuses on finding those hidden gems in the market. Companies that are trading for less than their intrinsic value.
Okay.
Imagine a company with a stock price of $50, but after careful analysis, we realize it's actually worth $100.
Right.
That's a value investor's dream scenario.
I see. So it's not just about buying cheap stocks, it's about buying quality companies at a discount.
Exactly. And what's fascinating is how these two approaches, DCA and value investing, can work together to create a powerful investment strategy.
I'm intrigued. How do they complement each other?
Think about it. DCA helps you smooth out market volatility by spreading your investments over time,
Right.
while value investing helps you pick the right companies to invest in. It's like having a safety net while also aiming for those home runs.
Okay, that makes sense. So if I'm using DCA,
Right.
instead of putting a large sum into the market all at once, I'm consistently investing smaller amounts, say, every month,
Yeah.
regardless of whether the market is up or down.
Precisely. And by combining that with value investing principles,
Okay.
you're ensuring that you're not just buying blindly, but strategically accumulating shares of companies that are potentially undervalued.
So how do we actually find these undervalued companies? How do we analyze them like Benjamin Graham?
Graham had a very specific method for analyzing companies focusing on their financial health, debt levels, earnings history, and a crucial concept he called margin of safety.
Okay.
For the listener, margin of safety is essentially buying a stock at a significant discount to its intrinsic value,
Right.
giving you a cushion to absorb potential market fluctuations.
Okay, that sounds pretty crucial. So margin of safety is like having a buffer protecting you from losses if the market takes a dip.
Exactly. And to determine this margin of safety and identify those undervalued companies, Graham developed a set of criteria that investors can use to evaluate potential investments.
I'm all ears. What are some of these criteria? I imagine it gets pretty technical.
It can, but we'll break it down. Some of the key criteria include things like a company's minimum annual sales, their current ratio, which measures their ability to pay short-term obligations, their debt-to-equity ratio, and their earnings history,
Right.
including dividend payments.
Okay, that's quite a few factors to consider. So, for example, when looking at minimum annual sales, what would be a green flag for a value investor?
Graham actually suggested a minimum of $100 million in annual sales, but considering inflation, that number would be much higher today.
Okay.
Think closer to $500 million.
Got it.
This is all about ensuring you're investing in a company that has a certain level of stability and scale.
Right.
You wouldn't want to invest in a company that's barely surviving, right?
Right, that makes sense. You want a company that can weather economic storms and has a solid foundation for growth.
Yeah.
What about their earnings history? What would be a good sign there?
Graham was a big believer in consistent earnings. He suggested looking for companies that have shown some earnings for common stock in each of the past 10 years. Even better if they have a history of uninterrupted dividend payments, let's say, for at least 20 years.
Okay.
It shows they are committed to rewarding their shareholders even during tough times.
So even with DCA, we're not just blindly investing,
Yeah.
but strategically choosing companies with a proven track record of solid performance.
Precisely, these criteria, while they might seem technical, give you incredible insight into a company's potential.
Right.
They help you make informed decisions, minimizing risk, and hopefully maximizing returns. It's like having a checklist to guide you through the investment process.
This is really starting to paint a clearer picture of how value investing works. So it's not just about finding a cheap stock and hoping for the best. It's about understanding a company's financials,
Yeah.
its ability to generate earnings, and its commitment to its shareholders.
Exactly. And this is just the tip of the iceberg. There's a whole world of metrics and ratios that we can dive into to really understand a company's value. But before we get lost in the numbers, let's take a step back and talk about something equally important: your investor personality.
Okay, investor personality. I'm curious, how does that play into all of this?
Well, not every investor is the same, right?
Right.
Some people are more comfortable with an active approach where they're constantly researching, buying, and selling stocks. Others prefer a more passive approach, setting up their investments and letting them grow over time.
I could definitely see how those are two very different approaches. So how do we know which one is right for us?
It all comes down to your comfort level, your risk tolerance, and how much time and energy you're willing to devote to managing your investments.
So self-awareness is key. It's about finding an investment strategy that aligns with who you are as an investor.
Exactly. And once you understand you're an investor personality, you can start to explore the tools and platforms that can help you implement your chosen strategy. For example, if you're more of a passive investor who loves the idea of DCA, there are many online platforms that can help you automate your investments.
That's interesting. So even within DCA, there are different approaches and tools available depending on your personality and preferences.
Absolutely, and that's what we'll explore further as we continue our deep dive. We'll look
Okay.
at the nuances of different DCA strategies, the tools and platforms available, and how to choose the right approach for you.
This is really helpful. I'm starting to see how all these pieces fit together.
Mm-hmm.
It's not just about finding a cheap stock. It's about having a comprehensive approach, combining a disciplined investment strategy with a thorough understanding of the underlying value of a company and knowing yourself as an investor.
That's a great way to put it. It's about aligning your investment strategy with your personality, your goals, and your risk tolerance.
All right, I'm ready to keep diving deeper. Let's move on to some specific examples and see how these principles can be applied in the real world.
Sounds good.
All right, I'm ready to see how all this works in a real-world scenario.
Yeah.
Let's look at an example where these principles were put to the test.
Okay, let's dive into a fascinating case study from your research notes.
Okay.
It involves a British company called Albemarle and Bond Holdings, which used to be listed on the London Stock Exchange.
Albemarle and Bond Holdings. Okay, I
Yeah.
remember reading about them. What made them stand out to a value investor?
At one point, their stock was trading at a massive 80% discount to their net current asset value, or NCAV.
Okay.
To clarify for our listener, NCAV is essentially a company's current assets minus its total liabilities.
Right.
It's a way to measure a company's liquidation value, what's left if they were to sell everything off and pay their debts.
I see. So an 80% discount to NCAV sounds like an incredible bargain.
It certainly catches your attention, doesn't it?
Yeah.
But remember, value investing is about more than just finding a low price.
Right.
It's about understanding the underlying business, its financials, and its future prospects.
Right. So we can't just jump in based on a discount alone. We need to dig deeper. What happened next in this case study?
A seasoned value investor became intrigued by this seemingly irresistible opportunity,
Okay.
but decided to apply a checklist based on Benjamin Graham's principles to assess the true potential of Albemarle and bond holdings.
Okay, so let's walk through that checklist. What were the key criteria that were considered?
First, the investor wanted to ensure they were dealing with a legitimate business, so they checked if the company was Chinese.
Okay.
At the time, many Chinese companies were involved in reverse takeover scams that often led to significant losses for investors.
So avoiding those scams was the first hurdle. Did Albemarle and Bond Holdings clear that one?
They did. The company was British.
Okay, good.
The next criterion was a low price to NCAV ratio, which, as we've established, Albemarle and Bond Holdings clearly met.
Right.
Remember, the lower the price relative to the company's net current assets, the larger the potential upside if the company recovers.
Okay, so they checked those two boxes. What came next on the checklist?
The investor then examined their debt-to-equity ratio. High levels of debt can be a significant warning sign for any company, especially those facing challenges.
And how did Albemarle and Bond Holdings fare in that department?
Unfortunately, not so well. Their debt-to-equity ratio was a hefty 70%.
Oh.
While this didn't automatically disqualify the company, it
Yeah.
did raise concerns about their financial stability.
I can see why that would be a red flag.
Hmm.
So high debt is a warning sign, but not a deal breaker in itself.
Right.
It depends on the context. What else was considered?
The investor then delved into the company's operational history, looking at their past earnings and exploring potential catalysts that could drive future growth or improve profitability.
So even though the company was trading at a discount, the investor was still looking for evidence of a solid business with potential. What did they find?
There were some positive indicators.
Okay.
Albemarle and Bond Holdings had a history of profitability, suggesting that their current struggles might be temporary.
Okay.
They had also traded above their NCAV in the past, indicating that the market had previously recognized their value.
Okay, so not all doom and gloom. Were there any specific events or situations that could have acted as catalysts for their growth?
That's a great question. A catalyst is basically an event or situation that can potentially unlock shareholder value more quickly.
Okay.
It's not essential for a value investment to succeed, but it can certainly accelerate the process.
So it's like a bonus boost of potential growth.
Exactly. In the case of Albemarle and Bond Holdings, there wasn't a clear catalyst on the horizon.
Okay.
However, the fact that they were actively closing down unprofitable locations suggested that management was taking steps to improve the situation.
So they were at least trying to turn things around. What was the next step in the evaluation?
The investor then examined whether the company was issuing new shares,
Okay.
which can dilute the ownership of existing shareholders and impact the value of your investment.
Right, that makes sense. You don't want your ownership stake to shrink without your consent.
Exactly. Fortunately, Albemarle and Bond Holdings were not selling shares at the time,
Okay.
which was a positive point in their favor.
Okay, so that's another box checked.
Mm-hmm.
It sounds like we're building a mixed picture here, some potential positives, but also some significant concerns.
You're getting it. Value investing is all about weighing the pros and cons
Right.
and making a calculated decision based on the overall picture.
Okay.
Let's continue down the checklist.
Okay.
The investor then moved on to some key quantitative factors,
Okay.
starting with their current ratio, a measure of a company's ability to meet its short-term obligations.
So a healthy current ratio is like having enough cash on hand to pay the bills, right?
Exactly. Ideally, you'd want to see a current ratio of at least 2.1,
Okay.
meaning the company has twice as many current assets as current liabilities.
Right.
This provides a cushion for unexpected expenses or a downturn in business.
And what was the situation with Albemarle and Bond Holdings?
Their current ratio was 1.51x, which, combined with their high debt load,
Yeah.
painted a concerning picture of their financial health.
Okay.
They were walking a tightrope, so to speak.
Mm-hmm. Not a very comfortable position to be in. What other quantitative factors were considered?
The investor also looked at the company's market capitalization,
Okay.
as smaller companies tend to have greater potential for outsized returns, although they can also be riskier.
So size matters in investing as well. And what was the verdict on Albemarle and Bond Holdings?
They definitely fit the bill of a small company with a market cap below £4 million.
Okay.
This meant that they had the potential for significant growth,
Right.
but also the potential for significant volatility.
Okay, so another factor to consider. What else is on the checklist?
The investor then analyzed the company's price to net cash ratio.
Okay.
Net cash refers to a company's cash and equivalents minus all its liabilities.
Got it.
A low price to net cash ratio indicates that you're essentially buying the company's cash at a discount.
That sounds like a pretty good deal.
It can be, but unfortunately, Albemarle and Bond Holdings did not have net cash on their balance sheet despite having significant gold holdings.
Oh.
Their liabilities outweighed their cash and equivalents.
Okay, so that's another opportunity missed. It seems like the negatives are starting to outweigh the positives here.
Let's not jump to conclusions just yet.
Okay.
The investors still had some qualitative criteria to assess,
Right.
starting with the nature of the business itself.
Okay.
They wanted to determine if the company was a financial institution, a regulated entity, a real estate company, or a closed-end fund.
And why are those types of businesses typically avoided by value investors?
These types of businesses can be more complex to analyze, especially for investors who aren't financial professionals.
Right.
They often have unique regulations, accounting practices, or market dynamics that can be difficult to fully grasp.
So it's about sticking to what you and understand. Well, did Albemarle and Bond Holdings fall into any of those complex categories?
No, they didn't.
Okay, good.
Their core business of pawnbroking while involving lending was not considered a full-fledged financial operation.
Okay, so they passed that test.
Yeah.
What were the other qualitative factors that were assessed?
The investor then looked at whether the company was buying back its own stock,
Okay.
which is generally seen as a positive sign, as it indicates that management believes the stock is undervalued.
So it's a sign of confidence from those who know the company best.
Precisely. Unfortunately, Albemarle and Bond Holdings were not repurchasing their shares at the time.
Okay.
They then considered insider ownership, whether those with inside knowledge of the company were buying or selling shares.
That's always an interesting data point.
Yeah.
What did they find?
The investor didn't delve deeper into that aspect because by this point,
Yeah.
the company's weak balance sheet, their high burn rate, the rate at which they were using up their cash reserves,
Great.
and their inability to find a buyer painted a concerning picture.
So the red flags were starting to pile up.
Yes, they were. Despite the initial allure of that 80% discount to NCAV,
Right.
the investor was starting to see that the risks associated with this investment were simply too high.
What a roller coaster.
Yeah.
So what happened in the end? Did the investor take the plunge?
No, they didn't. And it turned out to be a wise decision.
Oh, wow.
Just 2 months after this initial assessment, Albemarle and Bond Holdings filed for bankruptcy protection, and the shareholders who had bought into that seemingly irresistible discount were wiped out.
Wow, that's a stark reminder that even a seemingly cheap stock can turn into a complete loss if you don't do your homework.
It underscores the importance of not just focusing on the price,
Right.
but thoroughly understanding the underlying business, its financials, and its future prospects.
It's a valuable lesson in risk management, even when dealing with value stocks.
Absolutely. While this case study highlights the potential pitfalls, let's shift gears now and explore some success stories.
Yeah.
Let's look at how Benjamin Graham's principles can lead to positive outcomes when applied effectively and consistently.
Okay, I'm ready for some inspiration. Show me how this can work.
Benjamin Graham believed that an investor's potential returns weren't directly proportional to the risk they were willing to take,
Right.
but rather to the effort they put into their investments.
So it's not about gambling, but about informed decision-making.
Exactly. He recommended various investment strategies, each offering different returns and requiring varying levels of due diligence.
Okay.
He suggested starting with the least effort-intensive approach, investing in blue-chip stocks or index funds.
Okay.
This is essentially a passive investing strategy,
Right.
recognizing that most mutual funds don't outperform the market average.
So it's about mirroring the market's performance by investing in a diversified basket of well-established companies or a broad market index.
Exactly. This requires minimal effort and offers a relatively stable return over the long term.
Right.
It's the set it and forget it approach to investing.
Got it. But for those who want to be more hands-on, Graham recommended building a portfolio of what he called defensive-grade stocks.
Exactly.
Okay, defensive-grade stocks. What makes them different from blue-chip stocks or index funds?
Defensive grade stocks are those of companies that meet specific criteria aimed at identifying stable and financially sound businesses. These criteria cover factors like annual sales, financial ratios, earnings, history, dividend payments, earnings growth, and valuation metrics,
Mm-hmm.
similar to what we discussed in the Albemarle and Bond Holdings case.
So it sounds like we're applying those same principles of thorough analysis to a broader portfolio building strategy.
Precisely. These criteria help filter out companies that might be financially unstable or unreliable in terms of earnings and dividends.
Right.
For example, one of Graham's key criteria was a minimum of $100 million in annual sales, which adjusted for inflation would be closer to $500 million today.
That makes sense. You want to invest in companies that have a proven track record of generating significant revenue.
Right. And another crucial criterion was a healthy current ratio,
Mm-hmm.
ensuring the company can meet its short-term obligations comfortably.
Right.
Graham stipulated that a defensive-grade stock should have current assets at least twice its current liabilities.
That's a good safety net. It shows that the company has enough liquid assets to cover its short-term debts.
Exactly. And of course, Graham was very cautious about debt. He recommended that long-term debt should not exceed the company's net current assets.
So a company should ideally be able to cover its long-term debt with the assets it expects to convert to cash within a year.
Yes, that's the idea. And let's not forget Graham's emphasis on consistent earnings and dividend payments.
Right.
He looked for companies with a solid track record of generating profits and rewarding their shareholders.
So it's about finding companies that are not only financially sound, but also shareholder-friendly.
Exactly. While no investment is entirely risk-free,
Right.
this approach aims to minimize those risks by selecting companies with strong fundamentals and that crucial margin of safety.
And we can further enhance this by combining it with dollar cost averaging to smooth out market volatility.
Precisely. DCA and Graham's principles for building a portfolio of defensive-grade stocks work together beautifully to create a robust investment strategy.
So we got blue chip stocks and defensive grade stocks. Did Graham have any other strategies for those who are maybe a bit more adventurous?
He did. For those seeking higher potential returns and willing to accept a bit more risk, he recommended a category he called enterprising grade stocks.
Enterprising grade stocks.
Yeah.
So a bit more risk, but potentially higher rewards.
Exactly. With enterprising grade stocks, Graham relaxed some of the requirements, like allowing for a higher debt-to-equity ratio.
Okay.
However, he still emphasized earnings stability and required these companies to show no deficit in the past 5 years.
So even with higher risk, a consistent track record of profitability was still essential.
Absolutely. And he also looked for a dividend record,
Okay.
although not as extensive as for defensive-grade stocks.
Right.
Even a small dividend payment indicated that the company was committed to sharing its profits with shareholders.
Okay, so we're still looking for those shareholder-friendly companies.
Right. And for growth, Graham wanted to see evidence that the company was expanding its earnings,
Okay.
requiring that last year's earnings be higher than those from 5 years prior.
So even with the higher risk associated with these enterprising grade stocks, they still need to show signs of a healthy growing business.
Exactly. And finally, for valuation, Graham stipulated that the price of an enterprising grade stock should be less than 120% of the company's net tangible assets.
Net tangible assets being the company's total assets minus its liabilities and any intangible assets like goodwill.
Precisely. This metric helps ensure that you're buying the company's tangible assets at a reasonable price,
Okay.
providing a margin of safety even for these more speculative investments.
Okay, I'm seeing how all these pieces fit together to create different strategies based on different levels of risk tolerance.
Right.
It's quite a comprehensive system that Graham developed.
It is. He was a true pioneer in the world of value investing.
Yeah.
But he didn't stop there.
Okay.
He also recognized that there are sometimes unique investment opportunities that don't fit neatly into these traditional categories of stocks.
Yeah.
He called these special situations.
Special situations.
Wow.
That sounds intriguing. What are those all about?
These are typically unique investment opportunities that often involve events like mergers,
Okay.
acquisitions, or restructurings that can create opportunities for savvy investors to profit.
So it's about spotting those hidden gems that the market might be overlooking or mispricing.
Exactly. Let me give you an example.
Okay.
Imagine a company announces a plan to spin off a subsidiary.
Okay.
Let's say the spin-off is in a promising industry or has a strong track record of profitability.
Right.
A value investor like Graham might see this as an opportunity to acquire shares of the spin-off at a discounted price before the market fully recognizes its value.
Okay. I can see how that could be a profitable scenario.
It certainly can be,
Yeah.
but Graham cautioned that special situations require a particular mindset and expertise.
Right.
They're not suitable for every investor and often involve a higher level of
They're
risks.
not for the faint of heart.
Right. But for those with the experience and temperament for it, special situations can be a way to potentially generate significant returns.
It all comes back to those core principles of margin of safety and thorough analysis, even these more specialized scenarios.
Absolutely. Those principles are the foundation of Graham's investment philosophy, no matter what strategy you're employing.
Okay, we've covered a lot of ground here, from the fundamentals of value investing to different strategies and even special situations. It's a lot to take in, but it's fascinating to see how these principles can be applied in such a variety of ways.
It is. And the beauty of value investing is that it's not just a set of rules.
Right.
It's a framework for thinking about investing.
Mm-hmm.
It's about understanding businesses, evaluating their worth, and making informed decisions based on facts and analysis, not emotions or hype.
I'm starting to see that.
Mm,
It's about being a thoughtful and engaged investor, not just chasing the latest trends or hot stocks.
exactly. And the more you learn and apply these principles, the more confident and successful you'll become as an investor.
Yeah.
But let's move beyond the theory now and talk about the practical side of things.
Okay.
How can we use these principles to actually build and manage a value investing portfolio? What are some specific steps that investors can take?
Okay. Let's get down to the nitty-gritty. Where do we start?
The first step is to define your investment goals and risk tolerance.
Okay.
Are you investing for retirement, a down payment on a house, or something else entirely?
Yeah.
How much volatility are you comfortable with in your portfolio?
So it's about knowing yourself as an investor before diving into the market.
Exactly. Once you have a clear understanding of your goals and risk tolerance, you can then start researching potential investments,
Okay.
applying those Graham principles we've been discussing.
So that means digging into companies' financial statements,
Yeah,
understanding their industry, assessing their management team, and of course, determining your valuation.
precisely. It's about doing your due diligence and making sure you're investing in companies that align with your investment criteria.
That sounds like a lot of work.
Yeah.
Are there any resources or tools that can make this process a little bit easier?
Fortunately, there are numerous online resources available to investors,
They're not.
including websites, databases, and stock screeners that can help you filter and identify potential value stocks based on your specific criteria.
So we don't have to do everything manually. That's a relief.
Technology has definitely made value investing more accessible than it was in Graham's day.
That's great to hear.
Yeah.
So let's say we've done our research, used our tools, and identified some promising companies. What's the next step?
The next step is to construct your portfolio.
Okay.
This involves deciding how much to allocate to each investment and ensuring that your portfolio is well diversified across different industries and sectors.
Diversification is key to managing risk, right?
Absolutely.
Yeah.
You don't want to put all your eggs in one basket by
Yeah.
spreading your investments across different companies, industries, and even asset classes.
Right.
You can reduce the impact of any single investment performing poorly.
Okay, so we've built our portfolio. What's next?
The final step, and perhaps the most important one, is to regularly monitor and manage your portfolio.
So it's not just about setting it and forgetting it.
Not exactly. The market is constantly changing,
Right.
and your investments will fluctuate in value.
Of course.
You need to stay informed about what's happening in the market and with the companies you've invested in.
So even with a long-term focus, there's still an element of active management involved.
Yes, there is. This might involve rebalancing your portfolio periodically,
Okay.
selling investments that have performed well and buying more those that have lagged behind.
Right.
It might also involve selling investments that no longer meet your criteria or taking profits when an investment has reached your target price.
So it's about staying engaged and making adjustments as needed.
Exactly. And this is where the discipline of dollar cost averaging really comes into play.
Okay.
By consistently investing a fixed amount at regular intervals, you can navigate those market ups and downs without making emotional decisions.
It's about taking the emotion out of investing and sticking to a plan.
Precisely. Value investing combined with dollar cost averaging is a powerful strategy for building long-term wealth.
Right.
But it requires patience, discipline, and a commitment to continuous learning.
Okay.
It's a journey, not a destination.
And speaking of the journey, let's take a quick pause here. When we come back, we'll explore some additional tools and resources that can help you further refine your value investing approach and navigate that journey successfully. All right, we've laid out the foundation for value investing and dollar cost averaging. Now let's talk about those resources and tools that can really help us put all this knowledge into action.
Okay.
What do you recommend?
Let's start with a tool that many value investors swear by: stock screeners.
Okay.
These are online platforms that allow you to filter stocks based on specific criteria,
Right.
like those we discussed earlier: market cap, price to earnings ratio, debt to equity ratio, dividend history, and so on.
So instead of manually digging through information on thousands of companies, a stock screener helps us narrow down the search to companies that fit our specific investment criteria.
Exactly. It's like having a personal research assistant that does the heavy lifting for you.
Nice.
And the best part is that many of these screeners are available for free or as part of your brokerage account.
That's fantastic. It sounds like a must-have tool for any serious value investor.
Mhm.
What other resources should we have on our radar?
Don't underestimate the power of connecting with others who share your passion for value investing.
Okay.
There are countless online communities and forums dedicated to this approach,
Right.
where you can engage with fellow investors, share ideas, and learn from those with more experience.
I love that idea. It's like having a network of mentors and peers to bounce ideas off of and learn from their successes and mistakes.
Precisely. These communities can be incredibly valuable, especially if you're new to value investing.
Yeah.
You'll find discussions on specific companies, industries, and even broader market trends.
Right.
Many of them also offer educational resources like articles, webinars, and podcasts to help you deepen your understanding.
So it's a great way to stay informed, get different perspectives, and avoid some of those common investing pitfalls.
Exactly. And while online resources are incredibly valuable,
Right.
let's not forget about those tried and true sources of knowledge: books.
Ah, yes, the books.
There's a wealth of wisdom to be gained from reading books written by renowned value investors.
I'm always up for a good book recommendation. What are some of your favorites that you think every value investor should read?
Well, you can't go wrong with the classics by Benjamin Graham himself:
Of course.
Security Analysis and The Intelligent Investor.
Right.
They lay the foundation for value investing and are still incredibly relevant today.
They're considered essential reading for any serious investor.
Yeah.
What other titles would you add to that list?
Another excellent choice is The Essays of Warren Buffett. It's a collection of letters written by Buffett to Berkshire Hathaway shareholders, packed with his insights on investing, business, and even life itself.
I've heard those letters are like gold for investors.
They are. Buffett is a master storyteller and communicator, and his insights are both profound and practical. You'll find yourself highlighting passages and revisiting them time and time again.
Right, so books are a great way to delve deeper into the world of value investing. But what about staying up to date with current events and market trends?
Yeah.
What resources do you recommend for that?
Staying informed is crucial for any investor, and value investors are no exception.
Right.
Financial news websites, blogs, and podcasts can provide valuable insights into market trends, economic developments, and company-specific news.
It's about connecting the dots between what's happening in the world and how it might impact our investments.
Exactly. But remember, it's important to be discerning about your information sources.
Oh.
Focus on reputable sources that offer objective analysis and avoid those that promote hype or sensationalism. It's not just about consuming information, but consuming the right information.
I couldn't agree more. It's easy to get overwhelmed by the sheer volume of information out there. We need to be selective and critical thinkers.
You got it. Always remember to form your own conclusions based on your research and analysis. Don't blindly follow the crowd or get swept up in the latest market fads. Stick to those fundamental principles of value investing that we've discussed today.
This has been an incredibly insightful deep dive. We've gone from understanding the basic concepts to having a framework for putting those concepts into action, along with a toolkit of resources to help us along the way. I'm feeling much more confident and prepared to embark on my own value investing journey.
That's wonderful to hear. And remember, value investing is a journey, not a destination.
Right.
It's a continuous process of learning, adapting, and refining your approach.
And it's a journey that can be incredibly rewarding both financially and intellectually.
Absolutely. It's about building wealth over the long term while also gaining a deeper understanding of businesses and the market.
So as we wrap up, what's one final thought you'd like to leave our listener with?
Remember, while we've equipped you with the tools to analyze companies and make informed investment decisions, there's always an element of unpredictability in the market. Be prepared to adapt your strategy based on changing economic conditions and new information that comes to light.
That's a great reminder. We need to be flexible and willing to adjust our course as needed.
Exactly. Stay curious, keep learning, and never stop challenging yourself to become a better investor.
Great advice. Thank you so much for joining me today for this deep dive into the world of value investing.
It was my pleasure. Thanks for having me.
And to all our listeners out there, happy investing. Welcome to the deep dive. Today we're going to be exploring something pretty interesting, I think,
Okay.
and that is how to kind of like supercharge your investment strategy
Oh, nice.
by combining dollar cost averaging with the principles of the one and only Benjamin Graham,
Sounds good.
the father of value investing.
Yeah.
Um, Now, you might be prepping for a big meeting or simply looking to level up your investing game.
Mm-hmm.
Whatever your reason for tuning in, we're going to equip you with the knowledge and the insights you need to make smarter decisions.
Yeah, it's really a powerful combination, especially if you're looking to build wealth over the long term.
Yeah.
These two strategies might seem distinct at first,
Mm-hmm.
but they really work together beautifully to create a more robust and potentially more profitable approach.
Okay, so let's start with dollar cost averaging, or DCA, as it's commonly known.
Sure.
Um, I know a lot of our listeners might already be familiar with the basic concept,
Yeah.
investing a fixed amount regularly, regardless of market ups and downs. But what are some of the less obvious advantages, especially when we think about the psychology of investing?
That's a great point.
Yeah.
DCA is almost like a behavioral finance hack.
Okay.
Takes the emotion out of investing,
Mm-hmm.
which can be a huge advantage.
Yeah.
Think about it when the market is tanking.
Oh, yeah.
It's hard not to panic and sell everything, right?
Right.
But with DCA, you're already committed to buying regularly.
Yeah.
So you're less likely to make impulsive decisions based on fear.
I can definitely see how that would be helpful, especially for someone new to investing.
Yeah.
It's like having a built-in discipline coach for your portfolio.
Yeah, for sure.
Now let's bring Benjamin Graham into the picture.
Okay.
He was all about finding those hidden gems in the market,
Mm-hmm.
those stocks that were trading for less than their intrinsic value.
Right.
So how do his value investing principles fit in with DCA?
Well, imagine you've done your research using Graham's principles, and you've identified a company that seems significantly undervalued. Even with all the research in the world, there's always a chance that the stock price could drop further in the short term.
Right.
DCA can help smooth out your entry point by spreading your purchases over time, reducing the risk of buying all at once at a peak.
So even when you think you've found a great deal, DCA adds an extra layer of protection against those unpredictable market swings.
Exactly.
I like that.
Yeah.
Let's talk more about how to actually find these deals that Graham was so famous for uncovering.
Sure.
He wasn't just throwing darts at a board, right?
Right. Graham believed in rigorous analysis.
Okay.
He famously said, invest only if you would be comfortable owning a stock, even if you had no way of knowing its daily share price.
Wow.
He wanted investors to focus on the underlying value of a business, not just the stock's price fluctuations. He had specific criteria for identifying undervalued companies.
Yeah.
One of his most well-known concepts is the margin of safety,
Okay.
which essentially means buying assets for significantly less than they're worth.
Yeah, I've heard that phrase before, but it's one of those things that sounds simple on the surface, but probably has a lot more to it.
Yeah.
Can you break down what margin of safety actually means in practice?
Think of it this way.
Okay.
Graham aimed to buy $1 for 50 cents.
Okay.
It's about building in a buffer to protect yourself.
Mm-hmm.
Even if your initial valuation is a bit off, you're still getting a bargain, leaving room for error.
That's a fantastic way to think about it.
Yeah.
So how did Graham actually determine that 50 cents on the dollar value?
Right.
What were some of the metrics he used?
He used a combination of financial metrics and qualitative assessments.
Okay.
One key metric was the price-to-earnings ratio, or PE ratio,
Uh-huh.
which compares a company's stock price to its earnings per share.
Right.
A lower PE ratio can indicate that a stock is undervalued relative to its earnings.
I remember reading that Graham had some specific rules of thumb about PE ratios.
Yeah.
Something about avoiding stocks with a PE over a certain number.
You're right. He generally advised against buying stocks with a PE ratio higher than 10,
Okay.
regardless of how attractive the company might seem otherwise. And there's a very important reason for this.
Okay, I'm all ears. Tell me why this PE rule was so important to Graham.
It all goes back to the margin of safety.
Yeah.
A high PE ratio often means investors are paying a premium for future growth expectations.
Right.
That's fine if those expectations are met.
Sure.
But if they're not, the stock price could plummet, leaving investors with losses.
Right.
By sticking to a lower PE, Graham was essentially limiting his downside risk.
Why?
He wasn't willing to overpay for potential.
That makes a lot of sense.
Yeah.
It's like he was saying, if I can't get it at a bargain, I'll wait.
Exactly.
It's fascinating how this one metric connects back to his core philosophy.
Yeah.
Now, besides the PE ratio, what were some of the other financial metrics that Graham considered essential?
He was also a big believer in looking at a company's balance sheet. He wanted to see companies with low debt levels and a history of consistent earnings.
Hmm.
He'd often compare a company's long-term debt to its net current assets, wanting to ensure that the company could easily cover its short-term liabilities with its liquid assets.
So basically, he wanted to see a solid financial foundation,
Right.
even if the market wasn't giving the company much credit at the moment.
Yeah.
He wasn't looking for those high-flying speculative stocks that could crash and burn just as easily as they soared.
Yeah, exactly.
What else was important to him?
Another key metric he used was the ratio of shareholder equity to total assets.
Okay.
This gives you a sense of how much of a company's assets are financed by debt versus ownership.
Right.
A higher ratio generally indicates a stronger financial position.
Hmm.
And of course, he also considered a company's track record of paying dividends.
Dividends, those are always a good sign, especially when you're looking for long-term stable investments.
Right.
It's like getting paid to own a piece of a company.
Exactly.
Now, I remember reading about a more extreme application of Graham's ideas called net stocks.
Oh, yeah.
Can you tell me more about that?
Absolutely. And net stocks are companies trading for less than the value of their liquid assets minus all their liabilities.
Okay. Yeah.
It's essentially finding companies priced so low that even if they went out of business tomorrow,
Wow.
you'd theoretically get more back than you paid.
Wow, that sounds like bargain hunting on a whole other level.
Yeah.
I'm guessing this strategy is not for the faint of heart, though, right?
It's definitely a more niche strategy, and it requires careful due diligence.
Okay.
You need to be sure those assets are genuinely liquid and
Yeah.
readily convertible to cash.
Right.
And it's important to understand why the company is trading at such a steep discount.
Right.
Is it just temporary market pessimism, or are there deeper fundamental issues at play?
Right. Even with a seemingly straightforward formula like net,
Right.
I can see how Graham's emphasis on fundamental analysis would still be crucial. You can't just blindly buy any company trading below its net asset value and expect to make money.
Right.
It's about understanding the whole picture.
Precisely.
And speaking of understanding the whole picture, one of Graham's most famous analogies might help our listener grasp how he viewed the stock market. Have you
Yeah?
heard of Mr. Market?
Oh, yeah, Mr. Market. I love that analogy.
I love that analogy.
Yeah.
Can you explain it for our listener?
Graham imagined Mr. Market as an emotional business partner who comes to you every day,
Okay.
offering to buy or sell shares at a certain price.
Okay.
Sometimes he's wildly optimistic, driving prices up. Other times he's overly pessimistic, pushing prices down.
So for Graham, a savvy investor wouldn't get caught up in Mr. Market's mood swings.
Exactly. They'd see these swings as opportunities.
Okay.
When Mr. Market is overly gloomy, offering to sell at bargain prices, that's when the value investor steps in.
I love that. It's almost like turning Mr. Market's emotional roller coaster into your advantage. Now that we have a good understanding of Graham's principles, let's explore in more detail how they can be combined with dollar cost averaging to create a truly powerful investment strategy.
Great.
Yeah.
Let's do it.
All right. So we've talked about DCA as a way to take the emotion out of investing and Graham's principles for finding those hidden gems in the market. Now let's get into the nitty-gritty of how these two approaches can actually work together.
Yeah.
It's like having a dynamic duo of investment strategies, each enhancing the other's strengths.
That's a great way to put it. DCA provides a disciplined framework for investing consistently, while Graham's principles offer a roadmap for selecting quality assets.
Right.
Let's say you're already a DCA investor, diligently putting money into the market each month.
Right.
By incorporating Graham's ideas, you can move beyond just blindly investing at fixed intervals.
Yeah.
Start choosing companies with strong underlying fundamentals and that margin of safety we talked about.
It's like adding a layer of intelligence to your automated investing plan.
It's
Instead of just buying the same index fund every month, you're using DCA to gradually build positions in undervalued companies that you've identified through your own Graham-inspired analysis.
right.
That's powerful stuff.
Yeah. And for those who are already value investors,
Okay.
DCA can be a fantastic tool for managing risk, even when you're incredibly confident in your analysis.
Okay.
Remember, even the best investors can't perfectly time the market.
Right.
DCA helps smooth out your entry point, reducing the risk of buying all your shares at a relative peak, even if you found a company that seems like a steal.
So it's not just about catching those market dips,
Right.
but also about managing your risk even when you've done your homework and believe in the long-term prospects of a company.
Yeah.
That makes a ton of sense. Now, for our listener who's eager to put these ideas into practice,
Yeah.
what are some specific things they can take from Graham's playbook and apply to their DCA investing strategy?
A great starting point would be to look at the criteria Graham laid out for defensive investors in his book, The Intelligent Investor.
Okay.
He recommended focusing on companies with a long history of stable earnings, a solid track record of paying dividends,
Right.
and of course, a reasonable level of debt. He even suggested looking for companies with annual sales of at least $100 million.
Hmm.
But of course, that number would need to be adjusted for inflation today.
Right. $100 million in sales doesn't quite have the same weight as it did back in Graham's day.
Yeah.
So we're looking at the same principles, but
Mhm.
updating the numbers to reflect today's economy.
Exactly.
What about those all-important debt levels?
Sure.
How much debt is too much in Graham's view?
He was a big advocate for companies with manageable debt levels.
Okay.
Ideally, long-term debt shouldn't exceed net current assets.
Okay.
In simpler terms, he wanted companies that could easily cover their short-term liabilities with their readily available assets.
Where he was all about financial stability,
Right.
making sure a company had a solid foundation even if its stock price was temporarily depressed.
Exactly.
It's interesting, we've talked a lot about ratios and metrics, but it seems like Graham was also very much about understanding the qualitative aspects of a business as well.
Absolutely. He didn't just rely on numbers.
Okay.
He also emphasized the importance of understanding the company's management team, its competitive advantages,
Mm-hmm.
and its long-term prospects. Remember, you're not just buying a stock, you're buying a piece of a business.
That's a great reminder. Now, I know we've been primarily focused on stocks,
Sure.
but I'm curious if Graham's approach extended to other asset classes, like bonds, for example.
He certainly had interesting views on bonds.
Okay.
He wasn't a big fan of holding bonds when interest rates were low,
Okay.
arguing that they didn't offer a sufficient margin of safety.
Right.
He felt that when bond yields were high,
Hmm.
you could often find better value in stocks that had been unfairly punished by the market.
So it sounds like he was constantly evaluating where the best value lay, regardless of asset class.
Yeah.
Always searching for that sweet spot of risk and reward. Now, we've covered a lot of ground, but I'm wondering if there are any additional insights from your research. Perhaps some lesser-known aspects of Graham's thinking
Sure.
that our listener might find valuable.
One that comes to mind is his perspective on diversification,
Okay.
but with a twist.
Okay.
While he was a strong advocate for spreading risk across different investments,
Mm-hmm.
he also recognized the potential for including a small portion of high-risk, high-reward special situation investments in a portfolio.
That's fascinating. So even though he's known for his conservative approach, he acknowledged that there could be times when calculated risks might be warranted.
Right.
What exactly did he mean by special situations?
He was referring to companies facing unique circumstances, like a turnaround situation,
Oh.
a merger, or a new product launch that could potentially lead to significant price swings.
Mm-hmm.
These are situations where the market might misprice a company due to uncertainty or complexity.
So even with these more speculative investments, I imagine Graham would still apply his core principles of value investing.
Oh, absolutely.
He wouldn't just blindly gamble on any company facing a special situation, right?
Absolutely. He always emphasized that these special situations should only represent a small portion of a well-diversified portfolio.
Okay.
He still advocated for careful due diligence, understanding the company's fundamentals, and looking for that margin of safety, even in these potentially higher growth scenarios.
It's fascinating how he was able to balance seemingly contradictory ideas,
Yeah.
being both conservative and opportunistic,
Mm-hmm.
disciplined yet flexible in his thinking. It's like he understood that successful investing requires a blend of timeless principles and an ability to adapt to changing circumstances.
Exactly. And while Graham's principles were developed decades ago,
Yeah.
they're surprisingly relevant in today's market. But of course, we can't just blindly apply his ideas without considering how the investing landscape has evolved.
That's a great point. The market today is quite different than it was in Graham's time.
Yeah.
What are some of the key differences that investors should keep in mind when applying his principles to modern investing?
One significant difference is the rise of intangible assets, like intellectual property, brand value, and software.
Okay.
These assets can be difficult to value using traditional accounting methods,
Yeah.
which were the primary tools Graham had at his disposal.
Right.
So while we can still use his principles as a foundation, We need to be more creative in how we assess value in today's knowledge-based economy.
It's like trying to use a 20th century map to navigate a 21st century city. You might get the general lay of the land,
Yeah,
but you'll need some updated tools to find your way around.
exactly.
What are some other factors that make today's market different?
The pace of technological change is another crucial factor. In Graham's era, companies tended to be more stable, with
Right.
less disruption from new technologies.
Yeah.
Today, industries can be transformed seemingly overnight by innovations that weren't even on the radar a few years ago.
Right.
So investors need to be more adaptable and willing to reevaluate their assumptions as the world changes.
So it's not enough to just find a good company and hold on forever.
Right.
You need to constantly monitor the competitive landscape
Yeah.
and make sure the company is still innovating and adapting to new challenges.
Right. And that's where factors like understanding a company's management team, its culture of innovation,
Right.
and its ability to adapt become even more important.
Mm.
These qualitative factors can be just as crucial as the quantitative ones when assessing a company's long-term prospects.
This has been incredibly insightful.
Mm-hmm.
I feel like we've really started to connect the dots between dollar cost averaging and value investing.
Good.
But before we wrap up, I'd love to leave our listener with a thought-provoking question, something to ponder as they apply these ideas to their own investment journey.
I like that. What if we asked them to consider this?
Okay.
If Benjamin Graham were investing today,
Mm-hmm.
what specific industries or types of companies do you think he would find most attractive?
Mm-hmm.
Would he be drawn to those classic value plays like the consumer staples or healthcare companies he favored in his time?
Or would he be intrigued by the disruptive potential of newer industries like renewable energy, artificial intelligence, or even the metaverse?
Right.
It's fascinating to think about how his principles could be applied in so many different ways, depending on an investor's individual risk tolerance and investment goals.
That's a great point. And that's the beauty of his approach.
Yeah.
It provides a timeless framework for thinking about investments while allowing for flexibility and adaptation to the ever-changing market landscape.
Yeah, it's like a mental exercise in applying his principles to the modern world.
Yeah.
If Graham were here today poring over financial statements and looking for those hidden gems, where would he be focusing his attention?
Right.
It's a fun thought experiment.
It really is. And it highlights how these principles can be adapted and applied across different market conditions and industries. Think about it. Graham was writing during a time of industrial giants,
Yeah.
but today we're in an era of digital disruption.
So would he be more interested in those tech companies that are changing the way we live and work?
Mm.
Or would he stick to those more traditional businesses that have stood the test of time?
That's the million-dollar question, isn't it? He might be drawn to companies that are using technology to create new efficiencies or disrupt established industries, but I think he'd still insist on those core principles,
Yeah.
looking for a margin of safety, strong financials, and competent management.
It's almost like he'd be looking for those companies that are bridging the gap between the old and the new,
Right.
taking the best of both worlds,
Yeah.
companies that are embracing innovation while still adhering to sound financial principles.
Exactly. It's not about blindly chasing the latest trends, but about finding companies that are building sustainable businesses for the long term.
And that's what's so great about combining DCA with Graham's principles.
Yeah.
You're not just riding the waves of market hype.
Right.
You're building a portfolio based on solid foundations, brick by brick, dollar by dollar.
Well said. And remember, investing is a journey, not a destination. It's about consistently applying these principles, learning from your experiences, and adapting to new information.
So if our listener is ready to embark on this journey, what are some practical steps they can take to get started?
First and foremost, define your investment goals. What are you saving for? Retirement, a down payment on a house. Knowing your goals will shape your strategy and help you stay focused.
That's so crucial. It's like setting out on a road trip without a map.
Right.
You might enjoy the scenery, but you'll never reach your destination.
Once you have your goals in mind, it's time to choose the right tools.
Okay.
If you're going the DCA route, you'll want to find a brokerage account that allows for automatic investments.
And then comes the fun part, applying Graham's principles to select your investments.
Exactly.
Start by researching companies that align with your goals and risk tolerance.
Look for companies with a history of profitability, a solid balance sheet, and a competitive advantage that sets them apart. Don't be afraid to dig deep into those financial statements. And remember, you're not just buying a stock ticker, you're buying a piece of a business.
And of course, as with any investment strategy, diversification is key.
Yeah.
Don't put all your eggs in one basket. Spread your investments across different sectors, industries, and even asset classes if it aligns with your goals.
And finally, and perhaps most importantly, be patient. Building wealth takes time. Don't get discouraged by short-term market fluctuations. Stay focused on your long-term goals and let the power of compounding work its magic.
It's like planting a seed and watching it grow. It takes time, nurturing, and a bit of faith.
Beautifully put. So to our listener, remember to enjoy the process. Investing can be incredibly rewarding, both financially and intellectually. It's a continuous learning experience, and every decision you make is an opportunity to grow and refine your skills.
Well, thank you for joining us on this deep dive into dollar cost averaging and the timeless principles of Benjamin Graham.
Yeah, thanks for listening.
We hope you've gained some valuable insights to help you on your investment journey.
And remember, always stay curious, keep learning, and never stop exploring the world of investing.
We'll see you next time on The Deep Dive.
Welcome to our deep dive. We're going to be exploring value investing and dollar cost averaging.
Cool.
You've put together some awesome research.
Yeah.
Looks like you're really interested in using these to make smarter investment decisions.
Right.
And one thing that really jumps out are your notes about combining these strategies.
Yeah.
So we're going to get into all that.
Awesome.
So let's start with Benjamin Graham.
Okay.
And his idea of margin of safety.
Right.
Now, you highlighted this in your notes, so it obviously, caught your eye.
Yeah.
What is it about this principle that made you so interested?
Well, I think what's so interesting about Graham's approach is it kind of flips the script on traditional investing.
Okay.
So instead of chasing those high-growth, high-risk stocks, he's all about minimizing that downside risk
Right.
by focusing on those undervalued assets.
Okay.
His philosophy was to get assets worth $1 for 50 cents.
That sounds pretty simple in theory.
Yeah.
But how do you actually determine a company's intrinsic value?
Right.
I mean, that seems, pretty tricky.
Yeah, it definitely is.
Yeah.
Graham was a proponent of fundamental analysis.
Oh, right.
So he really believed in digging into a company's financials,
Right.
looking at things like the earnings per share, the book value,
Yeah.
that price-to-earnings ratio.
Okay.
He wanted to really understand the underlying business.
Right. Not just the stock price.
Exactly. Not just the stock price.
Now, he had specific criteria for identifying that margin of safety, right?
Yes.
It wasn't just any cheap stock would do.
Exactly.
So what were some of those?
So he favored things like a low price-to-earnings ratio,
Okay.
a high ratio of shareholder equity to total assets,
Mm-hmm.
and then also a price-to-book value under 1.5.
Okay.
So it's all about finding those companies with a really strong financial foundation.
Yeah, not just a temporary discount.
Right, exactly.
Okay, so it seems like he was very systematic in his approach.
Mhm.
What about his criteria for defensive stocks?
Okay.
I'd love to hear a little bit more about that.
So for Graham, defensive stocks represented companies that had a really proven track record.
Okay.
They could weather economic storms.
All right.
So think like consistent earnings and dividends for at least a decade
Okay, yeah.
and substantial size,
Mm-hmm.
ideally over $500 million in annual sales,
All right.
adjusted for inflation, of course.
Right.
These were companies that were built to last.
So you're looking for companies that are basically, financial fortresses.
Yeah, exactly.
That makes a lot of sense, especially for someone who's, looking to minimize risk.
Exactly.
Now, you've also expressed interest in dollar cost averaging.
Right.
And I'm curious to hear what sparked your curiosity there.
Okay.
What is it about dollar cost averaging that got you thinking?
All right.
Well, I think one thing that I find really intriguing is the idea of removing emotion from investing.
Okay.
And dollar cost averaging seems like it's a more systematic approach.
Yeah.
How does that resonate with you?
Yeah, I think that's definitely one of the most compelling aspects.
Uh-huh.
It takes that guesswork out of timing the market.
Okay.
So instead of
Right.
trying to predict that perfect entry point,
Right.
you're consistently investing a fixed amount
Okay.
at regular intervals,
Uh-huh.
regardless of those price fluctuations.
And it seems like that could be particularly beneficial in a volatile market, right?
Yeah, exactly.
So you're kind of taking advantage of those dips and smoothing out your overall cost basis.
Exactly.
Now, you specifically noted an interest in combining Graham's principles with dollar cost averaging.
Yes.
What was your thinking there?
All right.
How do you see those two kind of working together?
Okay. Well, it seems like there could be a really powerful synergy between those two.
Uh-huh.
So if you're consistently buying undervalued companies,
Right.
using Graham's criteria, wouldn't dollar cost averaging amplify the potential returns
Yeah.
and minimize the risk. Yeah, that's a really insightful observation.
Okay.
And by combining these two strategies, you're essentially creating a system
Okay.
to buy high-quality assets at a discount.
Right. And over time.
Over time, exactly.
Okay. And it seems like this kind of systematic approach would lend itself really well to automation.
Yeah.
And I noticed that you flagged that in your research.
Right, yeah, and several sources do point to those benefits
Okay.
of using automated investing tools
Uh-huh.
to implement dollar cost averaging.
Yeah.
Not only does it kind of simplify that process, but it also helps you mitigate some of those emotional biases
Okay.
that can lead to impulsive decisions.
Right.
So it's really hitting two birds with one stone.
So you're automating a smart investment strategy,
Yeah,
and you're potentially minimizing emotional pitfalls.
exactly.
Now,
Yeah.
and it's important to remember that no strategy is foolproof,
Right.
and there are always inherent risks and limitations,
Uh-huh.
right? So it's not all sunshine and rainbows, even with these approaches.
Right, yeah, exactly.
Hmm.
For instance, in a consistently declining market,
Yeah.
dollar cost averaging might not prevent losses,
Okay.
although it can help to kind of mitigate them.
Right.
And conversely, in a rapidly rising market, a lump sum investment
Yeah.
might actually outperform DCA.
Okay.
So it's really about aligning your strategy
Uh-huh.
with the market conditions
Right.
and your own risk tolerance.
It sounds like really understanding your investment personality and goals is crucial.
Uh-huh.
And that's something that you've also noted in your research.
Exactly.
So are you someone who enjoys researching individual companies
Yeah.
and actively managing your portfolio?
Right.
Or do you prefer a more passive approach?
Yeah.
I mean, those are some key questions to ask yourself,
Right.
because Graham's approach requires a certain level of active involvement,
Yeah.
whereas dollar cost averaging can be, incredibly passive.
Exactly. Yeah.
And I see you've also flagged, avoiding investments that feel too complex.
Right.
It seems like that aligns with staying within your circle of competence,
Yes.
which Graham really emphasized.
Yeah. That's a very astute observation.
Okay.
And understanding your limitations
Mm-hmm.
is just as important as recognizing your strengths
Right.
when it comes to investing.
So it's about making informed decisions
Yeah.
within your comfort zone.
Exactly.
Okay, so far we've covered the core principles of margin of safety and dollar cost averaging
Right.
and how they might work together.
Uh,
What other practical tips and considerations did you uncover in your research?
okay. Well, you specifically highlighted HODL
Yeah.
and buy the dip.
Okay.
And while these terms are often associated with that more speculative trading,
Uh-huh.
they can actually be adapted
Okay.
to that long-term value-oriented approach.
Okay, I'm intrigued. How do those concepts fit into a strategy focused on, Graham's principles and dollar cost averaging?
Okay, well, so HODL,
Yeah.
short for hold on for dear life, embodies that idea of weathering those market fluctuations
Okay.
and maintaining that long-term perspective,
Uh-huh.
which aligns perfectly with Graham's emphasis on patience and discipline.
Right, so you're not getting shaken out by those, short-term ups and downs.
Exactly, yeah.
What about buy the dip?
Okay, so buy the dip can actually be seen as a form of dollar cost averaging,
Okay.
as it encourages buying more of an asset when the price drops
Uh-huh.
and potentially lowering your average cost per share.
So it's interesting because these concepts that are often used in like short-term trading, right?
Mhm.
They can actually be really powerful tools for long-term investors
Yeah.
if you apply them in the right way.
Uh-huh.
Now, speaking of specific tools for evaluating companies, you also flagged insider ownership
Right.
and stock buybacks
Yeah.
as something to watch out for.
Mm-hmm.
I'm curious, why are those factors important?
Okay, well, insider ownership,
Yeah.
that's when company executives and board members purchase shares of their own stock,
Okay.
can actually be a positive signal
Okay.
because it indicates that those who are closest to the business
Right.
believe in its future prospects.
So they're putting their money where their mouth is.
Exactly, yeah.
Now, what about stock buybacks?
Okay, so similarly, stock buybacks,
Uh-huh.
when a company repurchases its own shares, can also be kind of a bullish sign.
Okay.
Suggests that management believes that the stock is undervalued
Uh-huh.
and that by reducing the number of shares outstanding,
Yeah.
it can increase earnings per share
Okay.
and potentially boost shareholder value.
So they're basically putting their money where their mouth is.
Exactly.
It's another way to gauge management's confidence
Uh,
in the future of the company.
yeah, exactly.
So you're looking for companies where management is aligned with shareholders
Yeah.
and believes in that long-term potential of the business. And you also mentioned the potential benefits of identifying catalysts.
Right.
What have you learned about that?
Okay.
Well, it seems like catalysts could provide an extra boost
Uh-huh.
to a company's value,
Right.
even if it's already undervalued according to Graham's criteria.
Absolutely.
Uh-huh.
So a catalyst can be any event or situation
Okay.
that could unlock shareholder value
Right.
in the near term.
Okay.
So it could be a new product launch,
Uh-huh.
a strategic acquisition,
Okay.
a regulatory change,
Right.
or even a shift in consumer behavior.
Okay.
So it's anything that could give them a competitive edge
Yeah.
or accelerate that growth trajectory.
So you're looking for something that could kind of, give the company a little extra oomph,
Yeah, exactly.
even if the underlying business is already solid.
Uh-huh.
All right. Well, this has been a fantastic deep dive so far. We've covered a ton of ground.
Yeah.
From Graham's principles to dollar cost averaging to practical considerations like insider ownership and catalysts.
Right.
I'm already feeling much more informed
Great.
and equipped to approach my investment decisions.
Good. I'm glad to hear that.
But before we move on, are there any risks or limitations associated with catalysts
Okay.
that investors should be aware of?
Yeah, that's a great question.
Okay.
While catalysts can be exciting,
Yeah.
they're not guarantees of success.
Okay.
Sometimes those anticipated catalysts fail to materialize.
Right.
Or their impact is less significant
Okay.
than expected.
Uh-huh.
So it's important to remember that they're just one piece of the puzzle
Right.
when it comes to evaluating an investment.
So you're saying you need to balance the potential upside of a catalyst
Uh-huh.
with the overall fundamentals
Right.
of the company
Exactly.
and, the inherent uncertainties of the market.
Yeah, a company with strong financials.
Yeah.
And that margin of safety should stand on its own,
Okay.
regardless of any potential catalysts.
So catalysts should be viewed as potential bonuses
Yeah.
rather than essential requirements
Exactly.
for a good investment.
They should just be one factor
Okay.
among many when you're considering an investment.
All right. Well, this deep dive has already been incredibly insightful.
Yeah, it has.
I'm eager to explore some more real-world examples
Okay.
and see how these principles can be applied in practice.
That's good.
So let's get into it.
All right.
Okay, I'm really excited to dive into some practical examples now.
All right.
In your research, you mentioned an interest in both retail and manufacturing companies.
Right.
Why did those industries kind of pique your interest?
Well, I think it's often easier for people to understand businesses that produce like tangible goods.
Yeah.
Their operations feel more concrete
Okay.
compared to, say, financial services or tech companies.
Right.
And that aligns perfectly with Graham's idea of staying within your circle of competence.
Yeah, you want to invest in things that you can grasp, not just chase the latest, trends or fads.
Right.
So let's start with retail.
Okay.
You specifically mentioned Walmart.
Right.
What makes them a potential candidate for a value investor?
Well, Walmart's a fascinating example because they're massive,
Right.
well-established company.
Uh-huh.
But remember, size doesn't automatically equal overvaluation.
Okay.
Value investing is about finding that disconnect
Right.
between a company's intrinsic worth and its current market price.
Uh-huh.
Even giants like Walmart can experience periods where their stock price
Yeah.
doesn't reflect their true value.
Okay.
So even though they're a household name,
Yeah.
there could be opportunities to buy Walmart at a discount.
Okay, so even though everyone knows Walmart, it
Oh.
doesn't mean that they're necessarily, a bad investment or that they're
Yeah.
overvalued.
Exactly.
There might still be opportunities there.
Right.
And that's where dollar cost averaging could be a valuable tool,
Yeah.
right? So instead of trying to time the bottom perfectly,
Right. Exactly.
you could just steadily accumulate shares over time, taking advantage of any dips along the way.
Exactly.
And as the market eventually recognizes Walmart's intrinsic value, your average cost per share would likely look pretty attractive.
Right.
Now, you mentioned earlier the concept of catalysts.
Yeah.
Could you give me an example of a catalyst that might apply specifically to a company like Walmart?
Okay. Sure.
let's say, hypothetically,
Yeah.
what could happen that would make Walmart even more attractive?
Let's say Walmart announces a major expansion into a high-growth market,
Okay.
like Southeast Asia or Africa.
Uh-huh.
That would give them access to millions of new customers
Right.
and potentially transform their growth trajectory.
Okay.
This kind of strategic move could re-energize investor interest
Yeah.
and lead to a reassessment of their long-term prospects.
So if you'd been consistently buying shares through dollar cost averaging, you'd be well positioned to benefit from that potential price appreciation. But catalysts don't always have to be huge, right?
Right, exactly. Yeah.
Even smaller catalysts can move the needle.
Yeah.
So, what would be an example of a smaller catalyst?
Like a successful new product launch
Okay.
or a cost-saving initiative,
Right.
maybe a strategic partnership.
Right.
These could all signal positive change
Yeah.
and potentially boost a company's value.
So you're always looking for those hints of positive change
Yeah.
that might not be fully reflected in the current stock price.
Uh-huh.
Okay, now let's shift gears to manufacturing.
Okay.
You've mentioned that you're particularly interested in this sector.
Right.
What specifically drew you to it?
Well, manufacturing companies often have tangible assets
Okay.
and a long history of operations,
Huh?
which can make them easier to analyze using Graham's principles.
Okay.
And one key metric he focused on was net current asset value, or NCAV.
NCIV.
Yes,
That sounds pretty technical.
it is.
Could you break that down for me?
Sure. NCAV is essentially a measure of a company's liquidation value.
Okay.
So represents the value of their current assets
Uh-huh.
minus all their liabilities.
Okay.
Graham was a big fan of finding companies trading for less than their NCAV.
So you're saying you're looking for companies that are so cheap
Right.
that you could theoretically buy them,
Yeah.
sell off all their assets,
Uh-huh.
and still make a profit,
Right.
even if the business itself went under.
Yeah, that's the idea.
Wow.
While finding companies trading below their NCAV is rare these days,
Okay.
the principle is still relevant.
Right.
You're looking for that significant margin of safety,
Mm-hmm.
that cushion between the stock price and the underlying value
Okay.
of the company's assets.
In my notes, I also highlighted the importance of management quality,
Right.
particularly in the manufacturing sector.
Yeah.
Why is that so crucial?
Well, a company's leadership can really make or break its success,
Uh-huh.
even if a company looks cheap on paper.
Yeah.
You want to make sure it's being steered by competent, ethical,
Okay.
forward-thinking individuals.
Right.
Look for companies with a track record of making sound decisions
Okay.
and creating value for shareholders.
So it's not just about the numbers.
Yeah.
It's about the people behind the numbers.
Exactly.
Can you give me an example of a manufacturing company that you think embodies these principles?
Sure. 3M is a company that often comes up in discussions of value investing.
3M. Okay.
They're known for their diverse product portfolio,
Uh-huh.
including iconic brands like Post-it notes and Scotch tape.
That's interesting.
Yeah.
I wouldn't have immediately thought of 3M as a value stock.
Right. They might not be a flashy, high-growth tech company,
Right.
but they've got a lot going for them from a value investor's perspective.
Okay.
They're financially sound.
Uh-huh.
They have a long history of consistent profits and dividend payments.
Okay.
And they tick many of Graham's boxes for defensive stocks.
So if their stock price dipped due to market conditions or some industry-specific concerns,
Right.
that could be a buying opportunity for a patient investor.
Exactly.
And again, dollar cost averaging could be an effective strategy in that scenario, allowing you to steadily build a position
Right.
in a solid company
Exactly.
without trying to perfectly time that market bottom.
Right.
One thing that stands out to me about 3M is their constant investment in research and development.
Yeah.
It seems like they're always innovating and coming up with new products.
Yeah, and that's a key characteristic that Graham looked for in companies.
Okay.
It's not just about finding cheap companies.
Mhm.
It's about finding cheap companies with the potential to become even more valuable over time.
Okay.
3M's commitment to R&D suggests they're not resting on their laurels,
Right.
but are actively seeking ways to evolve and expand their business.
It seems like they're playing the long game,
Yeah.
which aligns perfectly with the principles of value investing and dollar cost averaging.
Yeah.
Now, earlier, we briefly touched on the concept of special situations investing.
Right.
You mentioned that this was something Graham explored later in his career. Can you tell me more about that?
Sure. So special situations involve identifying companies undergoing unique events
Okay.
like mergers, spin-offs, restructurings
Mm-hmm.
that create opportunities for profit.
Okay.
These situations often require a deeper level of analysis
Right.
and a higher risk tolerance,
Okay.
as you're essentially betting on the outcome of these specific events.
So it sounds a lot more complex than simply looking for undervalued companies.
Can be, yeah.
And in my notes, I specifically highlighted a warning about avoiding complex investments that I don't fully understand.
And that's a wise approach.
Okay.
Even Graham himself acknowledged that special situations investing isn't for everyone.
All right.
It requires a particular mindset
Okay.
and a willingness to delve into the intricacies of corporate events.
So it's probably best for me to stick with the fundamentals for now.
Yeah, I think that's a good idea.
Focusing on finding undervalued companies with solid businesses
Mm-hmm.
and strong management teams.
Exactly.
Okay, so far we've explored real-world examples in both retail and manufacturing.
Right.
But investing isn't just about buying.
Uh-huh.
It's also about knowing when to sell.
Exact.
And I'm curious to hear your thoughts on that aspect of the process.
Okay, yeah, you're absolutely right.
So how do you determine the right time to sell an investment?
Yeah.
What factors should investors be considering?
Well, remember Graham's margin of safety.
Yeah.
When a stock's price approaches or exceeds its intrinsic value,
Huh?
that margin of safety starts to disappear.
Okay.
And that's a sign that the investment might be fully valued
All right.
or even overvalued.
So it's like a warning signal
Yeah,
that the potential upside is diminishing.
exactly.
Okay, so in those situations,
Uh-huh.
it might be prudent to consider taking profits,
Right.
even if you're still optimistic about the company's long-term prospects.
Yeah, exactly.
It's about recognizing when that risk-reward balance has shifted.
Exactly.
You also mentioned setting profit targets in your notes.
Yeah.
How do those fit into the selling equation?
Okay.
Well, I'm intrigued by the idea of setting profit targets
Huh?
as a way to, maintain discipline,
Right.
avoid emotional decision-making.
Yeah.
Seems like that could be particularly helpful in a volatile market.
Right. Profit targets are a valuable tool for ensuring you're not just reacting to
Yeah.
market swings,
Right.
but you're making deliberate decisions based on a predetermined plan.
Okay.
You're essentially deciding in advance at what price you'd be happy to sell.
So if a stock hits your profit target,
Yeah.
you'd sell,
Right.
even if you think it might continue to rise.
Right, exactly.
That seems kind of
It
counterintuitive.
can be tough to sell a winner,
Yeah.
especially if you believe it has more room to run.
Mm-hmm.
But remember, the market is unpredictable. Holding on for just a little longer can sometimes lead to giving back previous gains.
Okay.
So setting profit targets helps you to lock in profits
All right.
and stick to your plan.
But what if a stock keeps rising even after you've hit your profit target?
Yeah.
Do you never deviate from the plan?
There are times when it might make sense to adjust your strategy.
Okay.
If a company's fundamentals continue to improve
Yeah.
and you believe that the long-term growth story is still intact,
Uh-huh.
you might decide to raise your profit target
Okay.
or hold on to the stock for a while longer.
So it's about finding that balance between sticking to your plan and being flexible enough to adapt
Yeah.
to changing circumstances.
Exactly.
Now, you mentioned taxes earlier.
Right.
How do tax implications factor into selling decisions?
Well, depending on your jurisdiction and the type of investment account you're using,
Okay.
selling an asset can trigger capital gains taxes.
Yeah.
It's important to consider these potential costs
Right.
when making your selling decisions.
Taxes can be a headache,
Yeah.
but it's better to factor them in up front
Right.
than to be surprised by a big tax bill later on.
Exactly.
So we've covered recognizing when a stock has become fully valued,
Mm-hmm.
the discipline of setting profit targets,
Right.
and the ever-present consideration of taxes.
Yeah.
What other aspects of selling should investors be aware of?
Well, one of the most challenging aspects of investing
Okay.
is knowing when to cut your losses.
Right.
It's never easy to admit defeat,
Yeah.
but sometimes the best course of action is to sell an investment that's not performing as expected
Okay.
and move on to better opportunities.
That sounds painful.
It can be, yeah.
But how do you know when to throw in the towel on an investment?
Right.
What are the signs that it's time to move on?
Well, it's crucial to recognize when your original investment thesis is broken
Oh, okay.
or when a company's fundamentals have deteriorated significantly.
Uh-huh.
If the reasons you bought the stock are no longer valid, it
Yeah.
might be time to reassess your position.
So you're constantly monitoring your investments,
Yeah.
looking for any red flags
Right.
that might signal trouble ahead.
Exactly.
Are there any tools or strategies that can help investors manage this process?
Sure. Setting stop-loss orders can be a valuable tool
Okay.
for limiting potential losses.
Right.
A stop-loss order is an instruction to automatically sell a stock
Okay.
if it falls below a certain price.
So it acts as a safety net,
Right.
helping to prevent catastrophic losses
Uh,
if an investment turns sour.
Exactly.
So it kind of takes some of the emotion out of the equation,
Yeah.
forcing you to exit a position
Uh-huh.
before it potentially spirals further downward.
Right.
But aren't there risks associated with stop-loss orders?
Yes.
What if a stock temporarily dips below your stop-loss price,
Yeah.
triggering a sale,
Oh.
only to rebound shortly after?
Right. That's definitely a possibility.
Okay.
Stop-loss orders aren't foolproof. They need to be set thoughtfully,
Okay.
taking into account the typical price fluctuations of a particular stock.
So finding the right balance is key.
Ah,
You want to limit your losses,
right.
but you also don't want to be prematurely shaken out
Yeah.
of a good investment due to normal market volatility.
Exactly.
You mentioned earlier that human emotions can influence investment decisions.
Right.
How do emotions play into the selling process?
Well, we all have biases
Yeah.
that can cloud our judgment,
Right.
especially when it comes to money.
Huh?
Fear and greed are powerful emotions
Yeah.
that can lead to irrational decisions.
So we might hold on to losers for too long,
Right.
hoping they'll rebound,
Exactly.
or sell winners too early, fearing they'll give back their gains.
Uh-huh.
It's like we're fighting our own instincts.
Exactly. Yeah.
So what can we do about that?
It's crucial to be aware of these biases
Okay.
and develop strategies to overcome them.
Uh-huh.
Having a clear investment plan,
Okay.
setting realistic expectations,
Right.
and even talking to a trusted financial advisor
Yeah.
can all help you stay grounded and make more objective decisions.
This deep dive into selling has been eye-opening.
Good.
I feel much better equipped to approach this often neglected aspect of investing.
Yeah.
It's not just about picking the right stocks. It's
Oh.
also about managing risk,
Right.
controlling emotions,
Exactly.
and making disciplined decisions.
You've hit the nail on the head.
Okay.
Mastering the art of selling is just as crucial as mastering the art of buying.
All right.
It's all about finding that right balance
Yeah.
and aligning your actions with your overall investment strategy.
This has been an incredible journey so far.
It has.
We've covered so much ground, from Graham's principles and dollar cost averaging
Uh-huh.
to real-world examples and the nuances of selling.
Right.
I'm feeling much more confident in my ability to navigate the complexities of investing.
Good. I'm glad to hear that.
But before we wrap up,
Okay.
I'd love to hear your final thoughts on some broader themes that we've touched upon.
Yeah.
Specifically, the importance of understanding your investment personality
Right.
and the role of technology in the investment process.
Okay.
Are there any key takeaways you'd like to highlight?
Sure. Those are excellent points.
Okay.
Let's start with investment personality.
All right.
There's no one-size-fits-all approach to investing.
Right.
It's essential to find a strategy
Huh.
that aligns with your individual goals,
Okay.
risk tolerance, and temperament.
So it's not just about following a set of rules.
Uh-huh.
It's about finding an approach that feels right for you personally.
Exactly.
Now, what are some of those different approaches?
Well, some investors are naturally more comfortable with a hands-on approach.
Okay.
They enjoy digging into company financials, researching industries,
Yeah.
and actively picking individual stocks.
Right.
This aligns with Graham's style of deep dive analysis
Okay.
and finding undervalued opportunities.
And that's something that I definitely enjoy. I like the intellectual challenge of researching companies
Right.
and trying to identify those hidden gems.
Exactly.
Now, what about the other side of the spectrum?
Okay, so others prefer a more passive approach.
Uh-huh.
They might invest in broad market index funds
Okay.
or ETFs,
Right.
which provide diversified exposure to the market
Uh-huh.
without the need for that in-depth company research.
So that can be a very effective strategy.
Yeah.
Especially for those who don't have the time
Right.
or the inclination to actively manage their investments.
Exactly.
Now, are there other approaches besides those two?
Sure, there are those who fall somewhere in between,
Okay.
perhaps using a core satellite approach,
Yeah.
where they have a core portfolio of passive investments
Yeah.
and then allocate a smaller portion to more active stock picking.
Yeah, that's the hybrid approach we talked about earlier. It
Okay.
offers a nice balance
Uh-huh.
between diversification
Right.
and the potential for outsized returns. So it's about finding the right mix that suits your individual needs
Yeah,
and preferences.
precisely.
Now, throughout this deep dive,
Huh?
we've talked a lot about individual companies
Right.
and specific investment strategies.
Yeah.
But I'm curious to hear your thoughts on a broader concept that I came across in my research:
Right.
treating your portfolio like a business.
Oh, that's a fantastic analogy.
Right.
Just like a business owner,
Uh-huh.
you should regularly review your portfolio's performance,
Okay.
assess its strengths and weaknesses,
Right.
and make adjustments as needed.
It's not a set it and forget it endeavor.
Exactly, yeah.
So you're actively engaged in the process,
Uh-huh.
constantly monitoring,
Right.
making strategic decisions,
Yeah.
and ensuring your portfolio is aligned with your overall financial goals.
Exactly.
And just as a business owner needs to stay informed
Right.
about market trends and industry developments,
Uh-huh.
an investor needs to keep abreast of economic conditions, geopolitical events,
Right.
and any factors that could impact their investments. So it's
Exactly.
about being proactive and adaptable,
Right.
recognizing that the investment landscape is constantly evolving.
Precisely.
Now, speaking of evolving landscapes,
Yeah.
we can't overlook the transformative role of technology in the investment world.
True.
Technology has certainly revolutionized the way we invest.
It has.
It's incredible how much information and what powerful tools
Yeah.
are now available to individual investors.
It's truly democratized the playing field.
And we talked earlier about the potential of automation
Right.
for implementing strategies like dollar cost averaging.
Uh-huh.
But are there any other ways that technology is shaping the future of investing?
Sure. One area that's particularly exciting is the use of artificial intelligence
Okay.
and machine learning in investment analysis and portfolio management.
AI. So how are those being used?
Well, these technologies can process vast amounts of data,
Okay.
identify patterns,
Huh.
and potentially uncover investment opportunities that humans might miss.
So it's like having a superpowered research assistant
Yeah.
working tirelessly to analyze the markets
Yeah.
and identify the most promising investments.
Right.
But is this like a sure thing?
Well, AI and machine learning are still in their early stages
Okay.
of development in the investment world,
Right.
but they hold immense potential to enhance our decision-making capabilities
Oh, okay.
and potentially generate superior returns.
That's fascinating.
Yeah,
It seems like technology is constantly pushing the boundaries of what's possible in investing.
it certainly is.
But it's
Yeah.
important to remember that technology is a tool.
Right.
It can be used for good or bad,
Uh-huh.
and it's up to us as investors to use it wisely and ethically. So we need to be discerning consumers
Yeah.
of information and technology.
Right.
We need to understand the limitations of these tools
Uh-huh.
and not blindly follow algorithms or get caught up in the hype of the latest fintech innovations.
Exactly. We need to maintain a critical mindset,
Okay.
ask questions,
Yeah.
do our due diligence.
Right.
Technology can be a powerful ally in our investment journey,
Right.
but it's ultimately up to us to steer the ship.
As we wrap up this deep dive,
Okay.
I'd love to get your perspective on the future of investing.
Right.
What trends or challenges
Yeah.
do you see on the horizon that investors should be aware of?
Well, that's a great question.
Okay.
One trend that's already gaining momentum is the rise of sustainable investing,
Okay.
also known as ESG investing,
ESG investing. Okay.
where environmental, social, and governance factors
Mm-hmm.
are taken into consideration.
So ESG investing, I've definitely heard that term more and more lately.
Yeah.
It seems like investors are increasingly seeking companies
Mm-hmm.
that are not only financially sound,
Right.
but also operate in a responsible and ethical manner.
Exactly. It's about aligning your investments with your values, which is something that's becoming increasingly important
Yeah.
to investors of all generations.
So it's not just about maximizing returns.
Right.
It's also about making a positive impact on the world.
Exactly.
ESG investing is transforming the way investors evaluate companies
Uh-huh.
and make investment decisions.
Right.
And I believe this trend will continue to accelerate in the coming years.
I agree.
Another challenge I've been thinking about is the increasing complexity
Yeah.
of the global economy
Right.
with interconnected markets, geopolitical tensions,
Mm-hmm.
and rapid technological advancements.
Yeah.
It can feel overwhelming to keep up with everything that's happening.
That's a valid concern.
Okay.
The investing landscape is becoming more challenging to navigate,
Right.
and it requires a commitment to ongoing learning and adaptation.
It seems like you need a PhD in economics just to understand all the factors at play.
It can feel that way sometimes.
Yeah.
While it's important to stay informed,
All
remember, you don't have to be an expert in everything.
right.
The key is to focus on what you understand best
Okay.
and seek guidance from trusted sources when needed.
So it's about building a network of knowledge and support,
Uh-huh.
tapping into the expertise of others when you need to.
Exactly.
Okay, so don't be afraid to ask questions
Right.
and seek out different perspectives.
Yeah.
The more you learn, the more confident you'll become as an investor.
Exactly.
This deep dive has been a truly enlightening experience.
Yeah, it has.
We've explored the fundamentals of value investing,
Uh,
delved into the power of dollar cost averaging,
right.
examined real-world examples,
Yeah.
tackled the intricacies of selling,
Mm-hmm.
and even pondered the future of investing.
Right.
I'm leaving this conversation feeling informed, inspired, and empowered
That's great.
to take my investing to the next level.
Good. I'm glad to hear that.
But before we conclude, I have one final question that's been on my mind
All right.
throughout our discussion. In my notes, I highlighted this idea of finding the right balance between sticking to a plan and staying flexible.
Right.
How do you reconcile those two seemingly contradictory ideas?
That's a brilliant observation.
Okay.
It's a delicate dance, isn't it?
Yeah.
On one hand, you want to have a clear investment plan and avoid making impulsive decisions based on emotions or market noise.
But on the other hand, you don't want to be so rigid that you miss out on new opportunities or fail to adapt to changing market conditions.
Exactly. It's all about finding that sweet spot, that balance between discipline and adaptability. That's the hallmark of a truly successful investor. They can stick to their core principles while also being open to new information and adjusting their approach as needed.
It sounds like it's a continuous process of learning and adapting,
Right.
refining your strategy as you gain experience and navigate the ever-changing market landscape.
Precisely. And that brings us back to something we touched on earlier, the importance of temperament in investing. Graham believed that having the right temperament was just as crucial as having a solid understanding of investing principles.
So it's not just about knowing what to do, but also about having the emotional fortitude to actually do it.
Exactly. A successful investor needs patience, discipline, objectivity, and a willingness to learn from mistakes. These traits aren't just valuable for investing, but for life in general.
Absolutely. And one of the best ways to develop those traits is through experience.
Right.
The more you invest, the more you learn about yourself and how you react to different market situations. It's like a continuous feedback loop, constantly refining your approach and honing your instincts.
Precisely. And as you gain experience, you start to develop your own unique investment style, a personalized approach that reflects your individual personality, risk tolerance, and financial goals.
That reminds me of something you highlighted earlier, the importance of understanding your investment personality. Could you elaborate on what that means and why it's so crucial?
Of course, some investors are naturally drawn to a hands-on approach. They enjoy digging into company financials, researching industries, and actively picking individual stocks. This aligns with Graham's style of deep dive analysis and finding undervalued opportunities.
That resonates with me. I enjoy the intellectual challenge of researching companies and trying to identify hidden gems.
Others prefer a more passive approach.
Yeah.
They might invest in broad market index funds or ETFs, which provide diversified exposure to the market without the need for in-depth company research.
That can be a very effective strategy, especially for those who don't have the time or inclination to actively manage their investments.
Absolutely. And then there are those who fall somewhere in between, perhaps using a core satellite approach where they have a core portfolio of passive investments and then allocate a smaller portion to more active stock picking.
That's the hybrid approach we talked about earlier. It offers a nice balance between diversification and the potential for outsized returns. It's about finding the right mix that suits your individual needs and preferences.
Precisely. The beauty of investing is that there's no one right way to do it. The key is to find an approach that you're comfortable with, that aligns with your goals, and that you can stick to over the long term.
Now, throughout this deep dive, we've talked a lot about individual companies and specific investment strategies, but I'm curious to hear your thoughts on a broader concept that I came across in my research. Treating your portfolio like a business.
That's a fantastic analogy. Just like a business owner, you should regularly review your portfolio's performance, assess its strengths and weaknesses, and make adjustments as needed. It's not a set it and forget it endeavor.
So you're actively engaged in the process, constantly monitoring, making strategic decisions, and ensuring your portfolio is aligned with your overall financial goals.
Exactly.
Yeah.
And just as a business owner needs to stay informed about market trends and industry developments, an investor needs to keep abreast of economic conditions, geopolitical events, and any factors that could impact their investments.
It's about being proactive and adaptable, recognizing that the investment landscape is constantly evolving.
Precisely. Now, speaking of evolving landscapes, we can't overlook the transformative role of technology in the investment world.
Technology has certainly revolutionized the way we invest. It's incredible how much information and what powerful tools are now available to individual investors.
It's truly democratized the playing field. Online brokerages, research platforms, financial news aggregators, robo-advisors, the options are vast and constantly expanding. Technology has empowered individuals to take control of their financial destinies like never before.
And we talked earlier about the potential of automation for implementing strategies like dollar cost averaging. But are there any other ways that technology is shaping the future of investing?
One area that's particularly exciting is the use of artificial intelligence and machine learning in investment analysis and portfolio management. These technologies can process vast amounts of data, identify patterns, and potentially uncover investment opportunities that humans might miss.
It's like having a super-powered research assistant working tirelessly to analyze the markets and identify the most promising investments.
Exactly. AI and machine learning are still in their early stages of development in the investment world, but they hold immense potential to enhance our decision-making capabilities and potentially generate superior returns.
That's fascinating. It seems like technology is constantly pushing the boundaries of what's possible in investing.
It certainly is. However, it's important to remember that technology is a tool. It can be used for good or bad, and it's up to us as investors to use it wisely and ethically.
So we need to be discerning consumers of information and technology. We need to understand the limitations of these tools and not blindly follow algorithms or get caught up in the hype of the latest fintech innovations.
Exactly. We need to maintain a critical mindset, ask questions, and do our due diligence. Technology can be a powerful ally in our investment journey, but it's ultimately up to us to steer the ship.
This deep dive has been a truly enlightening experience. We've covered so much ground, from the foundational principles of value investing and dollar cost averaging to real-world examples, the nuances of selling, and even the transformative role of technology. I'm leaving this conversation feeling informed, inspired, and empowered to take my investing to the next level.
It's been a pleasure sharing this journey with you. Your insightful questions and genuine curiosity have made this conversation incredibly stimulating. Remember, investing is a lifelong pursuit. Continue to learn, explore, and refine your approach. Embrace the challenges, celebrate the victories, and never lose sight of your long-term goals.
That's fantastic advice. Thank you so much for your time, expertise, and insights. It's been a true pleasure exploring the world of investing with you.
The pleasure was all mine. Happy investing.
Welcome to the deep dive. You know, you sent over a bunch of notes, articles, even like snippets from investing websites, all about value investing and dollar cost averaging.
Okay.
It seems like you're really interested in applying these ideas, like maybe even using some of Benjamin Graham's wisdom
Yeah.
in your own portfolio.
Right.
Well, you've come to the right place.
All right.
We're about to take a deep dive into all that.
Okay.
But first, how about we start with what sparked your interest? Dollar cost averaging or DCA?
That's a great place to begin. DCA is a popular strategy,
Yeah.
especially for those who, like yourself,
Yeah.
are looking for a disciplined and consistent approach to investing.
Okay.
And it aligns surprisingly well with Graham's philosophy, even though he didn't explicitly talk about DCA in his writings.
Okay, I'm intrigued.
Yeah.
How does this accidental alignment work?
But one of Graham's core beliefs was that trying to time the market, guessing when to buy low and sell high,
Yeah.
is a fool's game.
Right.
He even had this colorful character he called Mr. Market
Okay.
to illustrate his point.
Oh, I've heard of Mr. Market.
Yeah.
Isn't he that unpredictable fellow who's
Yeah.
always offering you crazy deals? Sometimes great,
Yes.
sometimes terrible.
Exactly. Mr. Market is like that unpredictable friend who shows up at your door every day, offering to buy your stocks or sell you his.
Okay.
Some days, his prices are reasonable,
Right.
maybe even a steal.
Okay.
But other days, he's completely out of touch with reality,
Yeah.
asking way too much or offering pennies on the dollar.
So trying to time the market is like trying to outsmart this unpredictable
Yep.
Mr. Market.
It's right.
Sounds risky.
It is.
Yeah.
And that's where DCA comes in.
Okay.
Instead of stressing over when to buy, You consistently invest a set amount
Mm-hmm.
at regular intervals, regardless of what Mr. Market is doing.
So even when the market is down and everyone's panicking,
Yeah,
you just keep buying.
that's the idea.
Wow.
Some might call it buying the dip. Over time, this strategy can potentially lower your average cost per share and reduce the impact of market volatility on your portfolio.
Right.
Kind of like smoothing out the bumps in the road.
Ah, that makes sense.
Yeah,
It takes the emotion out of investing, lets you focus on the long game.
precisely.
Yeah.
And this long-term focus aligns perfectly with Graham's philosophy of value investing.
Okay.
He wasn't interested in quick flips or chasing the latest fads.
Right.
He was all about finding solid, undervalued companies
Okay.
and holding them for the long haul.
So DCA sets the stage for finding those undervalued gems.
Yeah.
And that's where Graham's wisdom comes in, right?
Absolutely.
Okay.
And it's interesting because your notes mention HODL,
Yeah.
which stands for hold on for dear life.
Right.
It's a popular term in the crypto world,
Uh-huh.
but the sentiment applies perfectly to Graham's approach as well.
Okay.
He believed in weathering the storms and letting your investments grow over time.
So we're talking about a marriage of DCA's consistent buying.
To Graham's long-term value-focused approach.
Exactly.
But how do we find those undervalued companies that Graham was so keen on?
Well, he had some specific criteria,
Yeah.
almost like a checklist, to identify these hidden gems.
Go.
And you've highlighted a few of his key principles in your notes, like margin of safety.
Ah, the margin of safety. That's a crucial concept.
Yeah.
It's like having a buffer, a safety net for your investments.
Exactly. Think of it like this. You wouldn't buy a used car without factoring in potential repairs, right?
Right.
You'd want some cushion in case something unexpected pops up.
Yeah.
The margin of safety is that cushion for your stocks.
Okay.
It's the difference between the price you pay and the actual worth of the company.
So we're not just buying any stock. We're looking for those trading at a discount to their true value.
Exactly.
Yeah.
And that's where things get interesting because Graham had specific ways to figure out this discount, to calculate a company's intrinsic value.
So it's not just about gut feeling or following the hype.
It's about digging into the numbers, analyzing a company's financials, and understanding its true worth.
You got it. Graham believed in a thorough analysis.
Okay.
He looked at things like the company's earnings, assets, debt levels,
Yeah.
and a host of other financial metrics.
Okay.
He even distinguished between two types of investors, defensive and enterprising,
Okay.
with slightly different criteria for each.
Sounds like we're about to enter the fascinating world of Graham's investment criteria.
We are.
But before we get lost in the numbers, do you think you could give me a quick rundown of what sets defensive and enterprising investors apart?
Certainly. The defensive investor, as Graham described, is someone who prioritizes safety and stability above all else.
Okay.
They're looking for consistent, if not spectacular, returns with minimal effort.
Okay.
Think of them as the tortoise in the investing race.
Mm-hmm.
Slow and steady wins the race.
Makes sense. And what about the enterprising investor?
The enterprising investor is more hands-on, willing to put in the extra work for potentially higher returns. They're comfortable with a bit more risk and enjoy digging deep into company financials.
Okay.
They're like the hare,
Yeah.
looking for those opportunities that could lead to a quick burst of growth.
So the tortoise and the hare of the investing world, I'm starting to see the distinction.
Yeah.
But how did Graham translate these personality types into specific criteria for selecting stocks?
He laid out some very specific guidelines, almost like a checklist for each type of investor.
Uh-huh.
Shall we start with the defensive investor?
Let's do it.
Okay, imagine you're a defensive investor seeking safety and stability.
Okay.
Graham would tell you to first look at a company's size.
Okay.
He wanted to see at least $500 million in annual sales.
Wow, that's a pretty substantial company. Why the focus on size?
It's all about mitigating risk.
Okay.
Larger companies tend to be more established
Mm-hmm.
and have a greater ability to weather economic storms.
Okay.
They're less likely to disappear overnight.
Right.
Remember, defensive investors prioritize safety.
Right, that makes sense. So big companies are a good starting point.
Right.
What else would a defensive investor look for?
Next up, financial health.
Okay.
Graham wanted to see companies with a strong balance sheet,
Mm-hmm.
meaning they have enough assets to cover their liabilities.
Right.
He has specific ratios he looked at, like the current ratio.
The current ratio.
Yeah.
Could you break that down for me?
Sure.
Okay.
Current ratio compares a company's current assets,
Okay.
things they can easily turn into cash,
Mm.
to their current liabilities, the debts they need to pay in the short term.
Okay.
Graham wanted to see a current ratio of at least 2.1.
So for every dollar of debt coming due soon,
Yeah.
they have $2 in readily available assets to cover it.
That's right.
That does sound pretty safe. What other financial checks did Graham recommend?
He was also wary of companies drowning in debt.
Okay.
He insisted that their long-term debt
Mm-hmm.
shouldn't exceed their net current assets. This ensures that even if they had to liquidate some assets to pay off their debts, they'd still have something left over for shareholders.
Okay, so size, a healthy balance sheet, and a manageable debt load.
Right,
It's all about minimizing risk for those defensive investors.
exactly. But Graham didn't just stop there.
Okay.
He also looked for companies with a proven track record.
Okay.
He wanted to see consistent earnings over the past 10 years,
Uh-huh.
ideally with some growth.
So no fly-by-night operations or companies with a history of boom and bust cycles.
Right.
It's about those steady Eddie companies that have weathered different economic conditions.
Precisely.
Okay.
And he also favored companies that pay dividends.
Mm-hmm.
He wanted to see uninterrupted dividend payments for at least the past 20 years.
Wow.
It's a sign of financial stability and a commitment to returning value to shareholders.
Interesting. So a consistent dividend payer can actually boost a defensive investor's returns
Yes.
without taking on extra risk.
Exactly.
Okay.
And finally, he wanted to make sure the price was right.
He used a couple of metrics like the price to earnings ratio or PE ratio and the price to book value
Yeah.
to ensure the stock was priced attractively relative to the company's earnings and assets.
So even if a company met all the other criteria,
Yeah,
he wouldn't buy it if it was overpriced?
right.
Like making sure you're getting a good deal on that used car,
Yeah,
even if it has a clean history and low mileage.
precisely.
Okay.
And those were just the defensive investor criteria.
Right.
Now, if we switch gears to the enterprising investor.
All right, let's talk about those hairs of the investing world.
Okay.
How do their criteria differ?
Well, enterprising investors are still looking for solid companies, but they're a bit more comfortable with risk and complexity.
Okay.
They're willing to roll up their sleeves and do some digging
Mm-hmm.
to uncover hidden gems that might be overlooked by more cautious investors. So while they're not cowboys throwing darts at a stock board,
Right.
they're not as risk-averse as our defensive investor friends.
Exactly. Graham still emphasized financial health for these investors,
Right.
but the criteria were slightly less stringent.
Okay.
For example, instead of requiring a 2.1 current ratio, he was okay with a 1.5.1 ratio for enterprising investors.
Okay, so a little more wiggle room there.
Right.
What about debt levels?
Right.
Was he still concerned about companies taking on too much debt?
Absolutely.
Okay.
But again, there was some flexibility.
Mm-hmm.
He allowed for debt to be up to 110% of net current assets for enterprising investors,
Okay.
compared to a stricter requirement for defensive investors.
Interesting.
Yeah.
So a bit more tolerance for leverage in the pursuit of higher returns?
That's right.
What else set the enterprising criteria apart?
He still wanted to see consistent earnings,
Right.
but instead of requiring a 10-year track record,
Yeah,
he looked at the past 5 years for enterprising investors.
makes sense.
Yeah,
A shorter track record might be acceptable if the company is showing strong growth potential.
exactly.
Okay.
And he still favored companies with a history of dividend payments.
However, he didn't place as much emphasis on this factor for enterprising investors.
Okay, so financial health and earnings consistency are still important,
Yes.
but with some adjustments for those willing to take on a bit more risk.
Right.
Any other key differences?
Here's where it gets really interesting.
Sure.
Graham added a requirement specifically for enterprising investors.
Okay.
He wanted the stock price to be less than 120% of the company's net tangible assets.
Net tangible assets.
Yeah.
Remind me what that means again.
It's a way to value a company based on its hard assets.
Okay.
Things like property, equipment, inventory,
Mm-hmm.
minus any liabilities.
Okay.
It's a very conservative measure,
Yeah.
focusing on the concrete value a company holds.
So essentially, he wanted to make sure these enterprising investors were buying assets at a discount,
Exactly.
even if those assets were a bit less liquid than what a defensive investor might prefer.
Precisely.
Okay.
It's all about finding that margin of safety no matter what type of investor you are. You've mentioned margin of safety a few times now.
Yeah,
I'm starting to see how crucial it is to Graham's philosophy.
it is.
But how did he actually calculate it? What specific metrics did he use to determine if a stock was truly undervalued?
That's a great question.
Yeah.
Graham had several tools in his arsenal for assessing margin of safety,
Okay.
and you've highlighted some of them in your notes.
Mhm.
Let's start with one you've circled,
Okay.
the price to earnings ratio. or PE ratio.
Ah, the PE ratio. I've
Yeah.
definitely come across that before.
Right.
But I'll admit, I'm still a bit fuzzy on how it works.
It's actually a fairly simple concept.
Okay.
The PE ratio compares a company's stock price to its earnings per share.
Okay.
It essentially tells you how much investors are willing to pay
Mm-hmm.
for every dollar of earnings the company generates.
Okay, so a high PE ratio means investors are pretty optimistic about the company's future growth,
That's right.
while a low PE ratio suggests they're a bit more cautious.
Exactly.
Okay.
And Graham was a fan of low PE ratios.
Mm-hmm.
He believed that companies with lower PE ratios were often undervalued by the market,
Okay.
offering a greater margin of safety.
So he wasn't chasing those high-flying, high-growth companies that everyone else was clamoring for.
Right.
He was looking for those solid,
Yeah.
steady businesses
I
that were
mean,
being overlooked.
Precisely.
Okay.
He even suggested specific benchmarks for the PE ratio.
Okay.
For example, he liked to see a PE ratio
Yeah.
lower than twice the average yield of AAA-rated corporate bonds.
Okay.
He believed that if a stock's earnings yield,
Mm-hmm.
the inverse of the PE ratio,
Right.
was higher than the yield on a very safe bond, it indicated an attractive investment opportunity.
Makes sense.
Yeah.
Why take on more risk with a stock if you can get a similar return with a much safer bond?
Exactly.
Right.
And Graham went even further.
Okay.
He sometimes suggested investors only consider stocks
Mm-hmm.
whose price is no more than 7 times their current earnings.
Wow.
He really wanted to ensure that bargain hunting mindset.
That's a pretty strict requirement.
It is.
It really shows his emphasis on buying with a significant margin of safety.
Absolutely.
Okay.
But the PE ratio was just one tool in his belt.
Right.
Another important metric he considered was the ratio of shareholder equity to total assets.
Okay, back to the balance sheet.
Yeah.
What was he looking for here?
He believed that companies should have at least twice as much equity as debt.
Okay.
This indicates a strong financial foundation and a lower risk of bankruptcy.
Right.
Think of it like this. You wouldn't want to buy a house with a huge mortgage and very little equity.
That's a great analogy.
Yeah.
A solid foundation is essential, whether we're talking about houses or companies.
Right.
So a high equity to asset ratio was a good sign for Graham.
Precisely.
Okay.
He wanted to see a ratio of at least 50%,
Uh-huh.
meaning the company had more assets than liabilities.
Okay.
This ensures that even if things go wrong,
Yeah.
the company has a cushion to absorb losses
Right.
and protect shareholder value.
Makes sense.
Yeah.
What other financial metrics did he use to assess margin of safety?
Liquidity was another key factor for Graham.
Okay.
He wanted to make sure a company had enough readily available assets
Right.
to cover its short-term debts,
Hmm.
ensuring they wouldn't face any cash crunches.
So back to those current assets and liabilities we talked about earlier.
Right.
How did he evaluate liquidity?
He looked at metrics like the current asset to liability ratio.
Okay.
He preferred to see current assets at
Mhm.
least 1.5 or 2 times greater than current liabilities.
Okay.
This means the company has a good buffer to meet its short-term obligations.
Okay, so plenty of cash on hand to pay the bills.
Right.
What about long-term debt?
He also looked at the debt to net current assets ratio,
Okay.
making sure that long-term debt didn't exceed the net current assets.
Mm-hmm.
Ideally, he preferred this ratio to be no more than 110% of net current assets.
Okay.
This helps ensure that a company isn't overburdened by debt and has a manageable financial structure.
So it's all about striking a balance. Having enough debt to fuel growth, but not so much that it becomes a burden.
Exactly.
Okay.
And you've also highlighted another metric that Graham used to assess value,
Uh-huh.
the price-to-book value ratio.
Ah, yes, the price to book value.
Yes.
Remind me how that one works.
This ratio compares a company's stock price to its book value per share.
Okay.
Book value is essentially the net worth of the company.
Okay.
Its assets minus its liabilities.
So a price to book ratio of 1 means the stock is trading at its book value,
That's right.
while a ratio below 1 suggests it's trading at a discount to its net worth.
Exactly.
Okay.
And Graham, being a value investor, Right. loved to find companies trading below their book value.
Okay.
He often suggested looking for companies with a price-to-book ratio of less than 1.5.
So he was basically looking for companies where the market was undervaluing their assets.
Exactly.
Like finding that hidden antique at the flea market that's
Yeah.
worth way more than the sticker price?
You got it.
Okay.
He even had a general rule of thumb. He suggested that the product of the price-to-earnings ratio
Mm-hmm.
And the price-to-book value ratio
Yeah.
should not exceed 22.5.
Okay, so even if a company had a low PE ratio,
Right.
he wanted to make sure it wasn't overvalued based on its assets.
Exactly.
It's like double checking the value of that antique at the flea market
Yeah,
before you hand over your cash.
precisely.
Okay.
And for those seeking an even more conservative approach,
Okay.
he recommended looking at the price-to-net tangible assets ratio.
Net tangible assets. Now, that sounds familiar.
Yeah.
Didn't we touch on that earlier when discussing the enterprising investor criteria?
Yes, we did.
Okay.
Remember, net tangible assets exclude intangible assets like goodwill or patents.
Right.
They focus on the hard, physical assets a company owns.
Right. So with this ratio, we're really getting down to the nuts and bolts of a company's worth.
Exactly.
What was Graham's benchmark for this ratio?
He suggested that the stock price should be less than 120% of the company's net tangible assets. This provides an extra layer of safety, ensuring that even if the intangible aspects of the business falter,
Right.
the underlying assets still provide value.
It's like valuing a company based on its physical inventory and equipment,
Right.
rather than its reputation or brand value.
Exactly.
This provides a more tangible and conservative measure of worth.
Precisely.
Okay.
And finally, we come to a metric that you've highlighted in your notes,
Okay.
the net current asset value, or NCAV.
Okay.
This was one of Graham's favorite measures.
Mm-hmm.
And it's a truly fascinating approach.
It sounds like it takes bargain hunting to a whole new level.
You could say that.
Yeah.
NCAV focuses on a company's most liquid assets:
Okay.
cash, receivables,
Hmm.
inventory,
Mm-hmm.
the things that can easily be converted to cash,
Okay.
and it seeks companies trading below this value.
Wow. So you're essentially buying the company's assets for less than they're worth
That's the idea.
and getting the entire business operations for free.
That's the idea.
Oh.
It's like finding a dollar bill for 50 cents.
Right.
But remember, while these opportunities do exist,
Yeah.
they're not as common as they once were.
I can imagine.
Yeah.
Finding a company trading below its NCAV must feel like hitting the jackpot.
It can be very rewarding.
Yeah.
But it's important to remember that even with NCAV,
Right.
thorough research and analysis are crucial.
Okay.
Just because a company is trading below its NCAV
Yeah.
doesn't automatically make it a good investment.
Okay.
There might be underlying reasons for this discount.
So it's not just about finding a cheap company,
Well,
but rather about understanding the story behind the numbers.
exactly.
Okay.
Why is the company trading at such a steep discount?
Yeah.
Are there hidden risks or challenges that the market is picking up on?
Right.
These are questions a savvy investor needs to answer before jumping in.
It's like a detective's investigation.
It is.
You have to gather all the evidence and piece together the puzzle before making a decision.
Precisely. And you've highlighted another interesting point in your notes.
Yeah.
One of your sources emphasizes the importance of looking beyond just the numbers and considering qualitative factors like management quality and insider ownership.
Right. It's not just about crunching numbers. It's also about assessing the people running the company.
Exactly. Yeah.
Oh.
If management has skin in the game
Yeah.
through stock ownership or buybacks,
Yeah.
it's a good sign that they're aligned with the interests of shareholders.
It suggests they believe in the company's future and are working to create value for all stakeholders,
Right.
not just themselves.
Exactly.
This reminds me of Graham's concept of the intelligent investor.
Ah, yes, the intelligent investor.
Yeah.
Graham believed that true investors shouldn't just blindly follow the market or chase the latest fads.
Right.
They should think for themselves,
Yeah.
carefully analyze companies, and make informed decisions based on sound principles.
And it's amazing how relevant his ideas still are today, even though he was writing decades ago. Long before the internet and all the information we have at our fingertips.
Absolutely.
Yeah.
He didn't have access to the powerful screening tools
Yeah.
and real-time financial data that we have today.
Right.
In a way, we have an even greater advantage as modern investors.
It's like having a superpower.
Yeah.
We can research companies in minutes, track their performance, and even see what insiders are doing with their shares.
Exactly.
But with great power comes great responsibility, right?
Exactly.
Okay.
We have to be careful not to get lost in the data
Right.
or become overly reliant on technology. Graham's core principles,
Yeah.
margin of safety, thorough research, a long-term perspective,
Right.
these are timeless and should guide our decisions,
Okay.
no matter how much data we have access to.
So it's not just about finding the magic formula or the perfect algorithm.
Yeah.
It's about developing a mindset,
Right.
a way of thinking about investing that can lead to long-term success.
Precisely. And that's what makes this deep dive so valuable. We're not just learning about specific metrics or strategies. We're exploring a philosophy, a
Yeah.
way of approaching the market that can benefit you for years to come.
It's been a fascinating journey so far.
It has.
But before we wrap up,
Okay.
I want to circle back to something we touched on earlier.
Yeah.
The idea of combining Graham's principles with dollar cost averaging.
Hmm.
It seems like a powerful combination,
It is.
especially for someone like our listener who's interested in a disciplined and consistent approach. It's kind of funny, like we started talking about dollar cost averaging,
Yeah.
which seems like a very modern approach. And
Hmm.
now we're like deep into Benjamin Graham's world, a
Yeah.
guy who was writing, back in the mid 20th century.
Right.
But it seems like these two ideas, DCA and value investing, fit together perfectly.
They do. And it makes sense when you think about it.
Yeah.
Dollar cost averaging helps to neutralize uh, the emotional ups and downs of the market, allowing you to stay focused on the long game.
Right.
And Graham's principles provide the framework for finding those undervalued opportunities
Yeah.
that DCA can capitalize on.
It's like having a steady hand to guide you through the turbulent waters of the market.
Hmm.
DCA keeps you on course, and Graham's principles help you navigate towards those hidden treasures.
That's a great analogy.
Yeah?
And speaking of navigating turbulent waters, it's worth revisiting Graham's view on market volatility.
Okay.
He didn't see it as something to fear,
Right.
but rather as an opportunity.
Didn't he have that whole Mr. Market metaphor to illustrate this point?
Exactly.
Yeah.
Remember that unpredictable fellow who shows up at your door every day, offering to buy or sell your stocks at wildly fluctuating prices?
Yeah.
That's Mr. Market.
Right.
He's a bit manic-depressive,
Okay.
driven by emotions rather than logic.
Yeah. So instead of getting swept up in his mood swings, we should see these fluctuations as chances to buy low when he's feeling pessimistic and sell high when he's overly optimistic.
Precisely. Graham believed that the true value of a company doesn't fluctuate as wildly as its stock price. So when the market irrationally drives prices down, that's when savvy value investors can swoop in and grab a bargain.
It's like that classic Warren Buffett quote, "Be fearful when others are greedy and greedy when others are fearful."
Exactly.
Yeah.
And that brings us to another important distinction that Graham made,
Okay.
the difference between investors and speculators.
Okay. This sounds intriguing.
Yeah.
How did he define these two groups?
He believed that true investors
Yeah.
are focused on the long term,
Mm-hmm.
carefully analyzing companies and their underlying value.
Right.
They're like detectives,
Okay.
piecing together the clues to find those undervalued gems that the market has overlooked.
So they're not just chasing the latest hot stock tip or
Right.
trying to time the market.
Yeah.
They're doing their homework and making informed decisions based on solid research.
Precisely.
Okay.
Speculators, on the other hand,
Yeah.
are more interested in short-term price movements,
Okay.
trying to make a quick buck by riding the waves of market sentiment.
Mm-hmm.
They're more like gamblers,
Right.
betting on the spin of the roulette wheel.
So while there might be some lucky speculators who hit it big,
Yeah,
it's a much riskier approach in the long run.
exactly.
Okay.
And Graham wasn't a fan of gambling with your hard-earned money.
Right.
He believed in a more disciplined and analytical approach,
Yeah.
focused on building wealth steadily over time.
And this ties back to dollar cost averaging, doesn't it?
It does.
It's a strategy that aligns perfectly with the mindset of a long-term investor.
Absolutely.
Okay.
DCA helps you tune out the noise of the market
Mm-hmm.
and focus on the fundamentals.
Yeah.
Buying consistently, regardless of the daily ups and downs, and letting your investments compound over time.
This has been a fascinating deep dive.
It has.
We've covered so much ground, from the foundational principles of value investing to specific metrics and tools for finding undervalued companies.
Right.
We've explored different investor personalities, the role of dollar cost averaging, and even touched upon Graham's unique perspective on market volatility.
It's been quite a journey.
It has.
And I think the key takeaway for our listener is this.
Oh.
Knowledge is power,
Mm-hmm.
but action is key.
Right.
Take what you've learned, do your own research,
Okay.
and consider how these principles might fit your investment style and goals.
And remember, it's not about finding a one-size-fits-all formula.
No.
It's about developing an understanding of the market,
Yeah.
a framework for making informed decisions
Right.
that align with your individual risk tolerance and financial aspirations.
And here's a final thought for you to consider.
Okay.
Graham focused primarily on publicly traded stocks.
Mm-hmm.
But how might his ideas apply to other asset classes, like real estate or even starting your own business?
That's a great point.
Yeah,
The principles of value investing, finding undervalued opportunities, assessing risk,
right.
and taking a long-term perspective can be applied far beyond the stock market.
Exactly. It's all about applying those core principles of careful analysis,
Yeah.
disciplined decision-making, and a patient approach to building wealth.
Well, on that note, we'll wrap up this deep dive into the world of value investing.
Yeah.
Happy investing.